Good morning. Ms. Chiller, are we ready to open the meeting?
Yes.
Can we open it at 10:01? You take the roll, please.
Chad Bradford.
Yes, ma'am.
Art Leary.
Here.
Mark Kennedy.
Here.
Ken Sutton.
Here.
We have a forum. Justin Campbell is no longer on the board. He's resigned. And we don't have someone to fill his spot yet. He was going to recommend somebody. So that would have to go in front of the commission.
Yes, ma'am. Has everybody had a chance to review last?
Please remember to turn on your mics when you talk.
Everybody had an opportunity to review the prior minutes?
I got one correction to make. The very last motion. It was me that seconded it, and so this, I think I'm the one that seconded it, not Sugden. Sugden wasn't here.
Wasn't here.
All right.
Thank you, sir. Thank you, Ms. Jill. Any other questions on the minutes? Accept the motion to accept the minutes.
So
A second.
Motion by Mr. Leary, second by Mr. Sugden. All in favor? Moving forward. Mr. Madron, Capital City. Good morning, sir. Thank you for coming.
Okay, it's on now. Okay, Dwayne Madron, Capital City Trust. Okay, and bad accident on Highway 100. Almost didn't make it. Big pile up. I think a log truck hit a car. Anyhow, so I guess we got the on the screen, we have the report for the firefighters. If you page down to the first bar chart, we can talk about calendar year 2023. So the firefighters pension fund approximately follows the S&P 500. Most of it does anyway. So that's the dark blue bar. So during 2023, the returns are quite good because the economy and consumer spending was better than expected. And that's a bright spot. Inflation moderated, came back a little bit in July, but after that, it pretty much stayed steady. The Federal Reserve signaled that they were almost done raising rates. So last fall, the market loved that information and went straight up. And so between October and January, the market was up more than 25%. But for the calendar year 2023, you'll see where growth stocks, information technology, and communication services, which includes Google and Facebook, did quite well, returning about 57%. And then you see where value stocks or defensive stocks like healthcare and utilities did not do well because in a fast-moving economy, investors tend to prefer growth stocks. And when the economy slows down, they drift into defensive stocks like healthcare and utilities. And of course, banks are having a tough time with a slowing economy and some commercial real estate woes. You can see where small cap R2K, the Russell 2000, lagged behind the S&P 500 because when there's a slow economy and a threat of recession, small companies pull back because they are not ready to deal with higher rates and higher inflation or materials cost and slower demand. So all in all, the stock market last year returned about 26%, which is outstanding. And it eclipsed what was lost in 2022. So the bright spot is we had a bad 2022. We made it all back last year, and now we're moving forward. If you turn the page or page down, please, Jill, we can talk about the stock market valuations. This chart is a couple months old, but the top line is the stock market, as many people define it. And the PE is the price to earnings ratio, a commonly used definition of valuation, and it was at 19.2. And that's because a lot of large companies became expensive, like Microsoft and Google and Tesla, Netflix, and Facebook, and NVIDIA, which is a semiconductor company. But if you look at the stock market equal weighted, where each company has the same weight, the valuation is much cheaper. So the illustration here is that, is the stock market expensive? On a size weighted basis, it is, because the top 10 largest companies in America are expensive. But if you pull those out, the other 497 companies are not as expensive. So the hope is, and the plan is, that eventually money will rotate out of the expensive stocks and into the cheaper stocks, like the banks and the healthcare stocks and the utilities. And that rotation is starting to happen very slowly. So is the stock market expensive? Depends how you define it. But sure, the tech stocks are expensive, and that's why you see the stock market tend to slowing down in the past couple of weeks. So if you turn the page or page down, Jill, to the policy review, you can talk about the fund as it's allocated today. So the policy percentage of market value is the actual. So for instance, large cap equities is 37.8, slightly underweight the policy of 40%, but within the range. So I pulled back on large cap about a couple months ago because it was starting to get expensive. And international is a little bit underweight because their growth is slower than ours, and their inflation is more of a problem than ours is. The rest of the small cap is underweighted because of the threat of a soft landing, but the rest of the fund is approximately weighted the same as the policy, which is the Burgess Chambers strategic model. And so if there's no questions on the policy stance, we can move on to performance. So this is for the fourth quarter of 2023. And I've got the fiscal year-to-date numbers. So the year-to-date is fiscal from September to today is 10.69, off to a good start on the fiscal year. The 1 and 3 and 5 years are the calendar year as of 12/31. So you can see where stocks returned 20.6 behind the S&P 500 because international and small cap lagged a little bit. If you go back to 5 years, it's made 12.7 per year. And then you can see where taxable bonds fiscal year to date returned 7.3. Those are the high yield bonds. They tend to follow the stock market because they're equity-like in nature. And you can see where cash returned 4.7 over the last year. Cash is now paying 5.2 in your fund, pays almost as much as a bond because the Federal Reserve has rates elevated. So cash is a nice defensive investment right now. If there's no questions on that, no, this is just the equity portion. Burgess will present the total fund in a minute. The next page over, I just included January, where January was a decent month. You can see where the year-to-date number stayed about the same. Stocks went up, the high-yield bonds went down a little bit, but we're off to a good start this year because there's hopes that the Federal Reserve sometime this year will lower rates. We're not sure when. It could be July or September, and that will help the stock market. In addition, what many people have noticed is that the stock market seems to be focused more on earnings surprises, and economic growth, and less focused on what the Fed is about to say. Because when the Fed makes announcements, the market isn't moving too much. It's already pretty much priced all that in. So it's looking forward to better economic growth. And the earnings season that just is about to conclude had terrific news. Many companies outperformed. And you probably saw some of them in the news. NVIDIA is one of them. The artificial intelligence theme is causing a lot of tech stocks to go up because there's some money to be made there. And one of them is NVIDIA. It's probably the 5th largest company in America now. It has a semiconductor that has a patent, and that semiconductor allows for great resolution on your TV screen or gaming screen, but it also is right in the middle of the artificial intelligence theme. So that's been a big winner. That stock is up about 260%. And because of its size in the index, it helped pull the stock market up. So that's all for performance. If you page down, Jill, to the asset allocation. So this is the total fund as of February 14th, $8,913,017, and it's 67% in equity. That includes the convertible bonds and the real estate as equity. And so that's a moderate growth portfolio. It's not aggressive, but it is growth. The rest of the report is just the holdings of the fund, which are mostly low cost index funds, which is a good thing. Any questions for me? All right, thank you. Thank you.
Good morning. You want me to sit here or go up there? Doesn't matter. Am I okay here? Okay. Good morning, everybody. I ask you to turn to page 8. I want to give you a sense of the strategic change that occurred when the new policy was adopted in August of last year. Yeah, you're okay. Perfect. So if you look at this chart and look at the table, you'll see that the domestic equity target allocation is 52%. That was increased from by 15%. That's so the new policy has shifted more emphasis into the domestic equities. We reduced the convertible bond allocation from 8 down to 5%. The international was decreased from 15% down to 8%. Private real estate was decreased from 7 to 5, and fixed income was increased from 22 to 24. So big picture, reason for this, we're de-risking to some extent because the idea was to reduce exposure to the non-US companies, particularly Europe and Asia. And what's happening, we all know what's happening with China. China is the 2nd largest economy in the world, but India is now the 5th largest economy in the world. I'm not sure you knew that, but India is probably going to be moving up the totem pole here over the next 5 years, and perhaps they will eclipse China at some point. But China may have topped out. They have a horrible real estate market, major collapse in bonds and bank financing, high unemployment, and stress in the global trade markets. Europe has just imposed a big import tax, a carbon tax they call it, on steel products, for example, from China. So that's kind of the reason why we decided to tamp down the exposure to international, and so far it's actually worked. U.S. stocks are actually doing better than non-U.S. stocks at this point, so that was a good move for you. If you go to page 7, you can look at his history here, and you can see, depending what time period you pick, results look rosy, and in some time periods they don't look so rosy. It's like, for example, the 3-year return of 2% per year that captures what Dwayne referenced. That is 2022. 2022 is a horrible year. Last year, 12.2% was a very solid year for you. And if you look at the 5-year average of 8.1, that makes Patrick happy. But the 10-year is right around 6%. Of course, the 10-year captures quite a bit of ebbs and flows in the stock market. And that's why it's right around 6%. If you go back further, if you go back 2 years ago and then do the 10-year from 2 years ago, the results are closer to 7.8%. So that's how much the impact 2022 had on the long-term averages. So on page 4 are the summary remarks. This is for everything you have here, including the assets that are under Dwayne's oversight and the bonds up and managed by Sawgrass. The program earned $824,000, 9.1% net, and you ranked in the top 20th percentile. That's fabulous. And I should add that the other 80% of the market, we're talking about pension plans now, they have tended to invest in things that aren't doing very well. They're heavily invested in, many of them are in private equity and hedge funds, and they have a heavier allocation to private real estate. And your program has really done very well compared to them because you have more beta, more market sensitivity than they have. I talked about the 5-year, the 3.3 million was earned over the last 5 years, 8.1% net. And we talked about the 10-year. Cohen & Steers is your infrastructure manager. They had a very nice bounce in the quarter. If you go to page 11, you can see they're up 12% for the quarter. How did they do that? Well, and that made up, they recovered nicely from the prior returns for the year that weren't that great. Cohen & Steers has about half of their portfolio is in utilities, very interest rate sensitive. And the discussion that many of us had during this quarter, about the Fed probably pausing on rate increases, that, as Dwayne mentioned, that created a lot of excitement in both stocks and bonds. Anything that was interest rate sensitive did very well during the quarter for that reason. And I should go back to page 12 and talk about your bonds for a minute. You know, for many years, the bonds averaged on a 10-year basis right around 1%. And what we've seen in just recently with this rally in the bond market, the yield to maturity on this portfolio now is pretty close to 6%. We haven't had that kind of positioning looking forward, those return expectations in 20 years. So the bonds are going to be more important in terms of delivering returns to the plan than they have in many, many years. I would say while we're on this page, we're the soft spot here with about a 5% allocation is the American Core Realty product. Down 13% for the year. This is all the result of marking down the value of primarily office. There's some multifamily and that those markdowns more recently, believe it or not, and a little bit in industrial, but it's primarily office. They don't really have a retail exposure other than anchored strip centers, which have actually fared well in this environment. With 18 or 19% exposure to office, commercial office around the country, that will be a area of continual stress probably for the next couple of years. But I think that this product long-term will do fine for you. It's just, we have to get through this adjustment phase. I should add that the balance sheet of the trust is very strong. The leverage is only about 19%. Their loans are, they have a number of term loans, nothing coming up in the near future. There's no exposure there in terms of their inability to refinance the debt that's in the trust. That's it. Any questions? Art, you have any questions since you're a banker? I know you're always thinking.
That's the thing. Problems before we get home.
Well, the big dilemma, and I know you're very in touch with this more than I am, but there's an enormous amount of commercial lending that's stressed. There are loans that are coming due across the country. We're talking in the, probably close to $2 trillion, 1.4, 1.6 trillion, just call it an even 2 trillion. These are merchant builders and developers that took on a lot of debt, say 3, 4, 5, 6 years ago at very low rates. And now they have to refinance this year, next year, and the year, next 2 or 3 years of refinancing. And the banks don't want to make these loans. Some of the banks are modifying the loans, giving them some extensions, but the problem is the banks want more equity, and Art is an expert in this area. And these borrowers just don't have the cash to put the equity down, so they're walking away from these deals. But there are big companies in this space that, KKR and BlackRock and others that are going to, JP Morgan, that are going to pounce on these deals when they get cheap. So to that extent, it'll work itself out. But that's where I think the greatest uncertainty is right now. How long will interest rates stay up? And the longer they stay up, the more it's going to stress the commercial real estate market from a refinancing perspective. Would you agree with that? I think that's the biggest cloud on the horizon right now. Earnings, as Dwayne pointed out, are pretty reasonable. And I think what Dwayne is hoping for, and I think it's going to happen, we'll see a more evenness in the overall price to earnings multiple of the market, meaning the tech names that he talked about that are very concentrated right now in especially the large cap growth and the S&P 500. We need a little bit of a pause. They need to kind of slow down their growth profiles a little bit and spread the wealth across other sectors. That's my short answer. That talk too much? Okay. Anything else?
Yeah.
Okay.
We'll make a motion to accept. So, motion by Lindsay, second by Sugden, all in favor? Thank you, sir.
Thank you.
Mr. Donlin, if you will.
Jill, may I make a statement? I forgot to introduce our market president, Keith Winston from Capital City Bank. He came today, so I appreciate it.
Welcome, thank you.
Did you drive with him?
No.
That's good. You're lucky you'd have to drive with this guy. Good news, good school.
All right. I brought with valuation reports, I brought a few copies I handed out. I don't know if you're gonna put it on the screen also or no. And then you guys have it in your packet, or you can use the archives, either way. But if everybody wants to go to page 6 of the document. So Burgess told me to give you good news. I have fair news, I guess is what you would call it. But, every year, as of October 1st, we look at the assets in the pension plan and then we project out all the future retirement benefits. And we say, okay, well, there's not enough money to pay all those future retirement benefits, so we determine an appropriate funding requirement for the next year. And we always do it 1 year ahead so that the city can budget. So the right-hand column is the snapshot evaluation date, October 1, 2022. That's when we looked at it last year. And that determined the requirements for the year that we're in right now. So right now, we're in this fiscal year ending 9/30/2024. And the total city and state requirement is 35.3% of payroll. So at the end of the year, we're gonna say, okay, what was the payroll? Was it $1 million? Then 353,000 will be the requirement. And then we'll take off whatever comes in from the state, and that's the city requirement. So right now, it represents about 30.6% of payroll. And then the left-hand column is for next year. And, you know, Burgess just gave you a good report, and he said, oh, you had a good year on the investments. But he also mentioned that we had one terrible year in 2022, right? Everybody had a terrible year in 2022. And we use a smoothing technique with the valuation. And so we don't want the city's cost to go way up and way down here. So we spread out those investment gains or losses. So that 2022 investment loss, we're still recognizing some of that. And we're recognizing some of the gain that we had in 2023. So, and also individual salary increases were higher than normal. I think you guys have negotiated a contract a couple of years ago where you got salary increases. And so I said, we look at the assets and we project everybody's future benefits. Well, if salaries are higher, then everybody's projected benefits are higher because your benefit is based upon your final average compensation. So that created a bit of an actuarial loss this year. So even though we had a good year on the investments, all told, the costs are going up a little bit. So for next year, the total required contribution is 42.9. Members contribute 6. So the city and state requirement is 36.9% payroll for next year. And then it'll offset whatever comes in from the state and then the bottom line city. So as of right now, based on current payroll and current state monies, that's 32.2% payroll. Anybody have any questions about that page? So I talked about the investments and well, maybe I'll have you go to page 10, just a couple pages later. But yeah, right, scroll a little bit more down. So, you know, this is all of our evaluation results and it has statistics from last year and this year. But you can see there's assets. We have market value, and the market value went up quite a bit. And then we have actuarial value, and that didn't go up quite as much. And that actuarial value is what we're using for this valuation, you know, to determine those funding requirements. And so, you know, note though that right now you're actually being helped by the smoothing because the cost would be higher if we were not smoothing, because that 22 loss was devastating and we're spreading it out over 5 years. If we would have recognized it immediately, then everybody's costs would have went way up that year. So then if you scroll back to page 32. We'll go just a tiny bit more down. So at the beginning of the year, you guys had $8.3 million in the plan. That was the market value of assets at the beginning of the year. And so we have a 7.4% assumption. That's what we're expecting. And so it takes 7.4% of that 8 million. We expected to earn 621,000 this year in fiscal 2023. You know, Burgess just gave you the report for calendar, basically, ending 12/31, but this report uses 9/30, September 30th. And the end of the year was really good from September 30th through December 31st. So for the fiscal year, you guys got 7.73%. So you did beat the assumption. So you beat it by 19,485. So then in the upper left-hand section there, we're going to spread that $19,000 gain over 5 years. So we're going to recognize basically 4,000 of it each year for 5 years. But 2022, you can see there, we had a $2.4 million loss because we expected 7.4 and we got like minus 16 or something like that. So, you know, we had like a 23% loss. So, you know, that's the big story that you guys need to remember from last year. So that loss we're spreading out. So if you scroll to the bottom of the page, using that smoothing, we had a 3.4% return. And so based on our 7.4 assumption, we had an actuarial loss there of 390,000. So, you know, we're off to a good start this year, which could help offset some of that. But likely the next 3 years, we're probably going to have actuarial losses on the investment because we're still going to recognize 1/5 of that 2022 loss. You know, this is our second year of recognizing it, so we have 3 years left to go. Does anybody have any questions about that smoothing? So then, page 38. That's the turnover, and you know, a lot of times things that are good for the pension plan are bad otherwise, and vice versa. So in this case, you guys had a lot of turnover, which actually helped the pension plan. So at the beginning of the year, you had 25 firefighters. You had 2 of them terminate vested, and then you had 4 firefighters terminate and take refunds of their own contribution. So when a firefighter terminates and takes a refund, well, all they get back is their own contribution. So the city contributions, the state monies, the investment returns, all that stays in the plan. So it's a gain when you have more turnover, and that's what happened this year. And then you hired 3 new firefighters, so you actually went from 25 to 22. I don't know if that was a temporary thing or what, but you know, maybe next year when we do the 2024 evaluation, you'll be back up to 25. I don't know, but you did end the year lower than you started. At the bottom of the page is the retirees. And again, you know, a good thing is that all of your retirees live to see another year and collect benefits. So that was actually a negative thing for the pension plan. So then I'll take you back to page 18. So this is your unfunded actuarial accrued liability. And basically, on an actuarial basis, using that smooth actuarial value of assets and your accrued liability, what's the difference between the assets than the accrued liability. And last year, there was $1.89 million in liabilities that exceeded the assets on an actuarial basis. But we're making a payment each year to pay that down, the city is. So we expected that to go to $1,522,000, and in the end, it was $2,213,000. So we had a net actuarial loss there of $691,000. That means the liabilities compared to the assets, that difference grew a little bit from 2021 or 2022 to 2023. And you can see the reasons in the middle of the page. So the investment return, using that smoothing, that created an increase in the liabilities or a reduction in the assets of $390,000. And then the fact that salary increases were higher than expected, that was a loss of $393,000. And then the active decrements, that's the turnover, that was a gain of $188,000. Inactive mortality was a loss. One vested terminated member retired, other minor issues. So we get a total there of $691,000. So you can see it was basically all from the investment return and the salary increases. So that was the big story in the report. And if you go to the previous page, page 17, we've got a bunch of little mortgage payments, like this unfunded actuarial accrued liability, that $2.2 million unfunded liability that we have, we're paying that off over time. So the $691,000 loss we had this year, we're going to pay $72,000 for 15 years to pay that off. So this mortgage payment is now $296,000 a year. You know, that changes each year, and we're paying it down, but it went up. You can see those that last item, it went up about $72,000 just because of the actuarial loss that we had this year. And that's the main reason why the cost went up back on page 6. So if you go to page 13, so the top line on page 13 is the normal cost. And what that is that's just each active firefighter, they're accruing benefits each year, right? And so, you know, the cost for that is about 19.7% of pay. That's if all of our assumptions are met. If we had exactly our investment return, exactly the turnover, all that, it would be 19.7%, this year 19.6%. And then administrative expenses are our fees, any education you guys get, anything we pay Jill's group, anything like that is administrative expenses. That's not part of the benefits, so that's a separate line item. And that went from 2.6 to 2.9% payroll. But then the big issue is that third line. That's that mortgage payment. That's paying down that unfunded actuarial accrued liability. That went from 19% to 20.4%. So you add those three together, and that gets you your total requirement, 41.3 to 42.9. The same numbers we saw back on page 6. Something people look at is that funded ratio, which is on page 11. So, you know, we talked about that unfunded actuarial accrued liability, looking at the liabilities compared to the assets, and the difference was 2.2 million. Well, that's as a dollar amount. If you look at it as a percentage, taking that accrued liability divided by the assets, you went from 83.7% funded ratio the 82.1% funded ratio. And plans want to be in that 80 to 100%, but you're still in the healthy range of funded status.
How do we compare to others like us?
Well, every year we do a survey of all of our plans, or most years. I can look it up real quick and tell you. But the average, I think, was like 87 last year, maybe, but you're not far out of line. You're in the range of most of our plans. So those were kind of the highlights and lowlights of the valuation report, but I'd be happy to answer any more questions anyone.
I've got one if you got, yep. So the question about the third-party administrator we've been talking about, what does that do to our administrative expense? Does that number go up or down as far as the city's portion?
I can't remember, is the city, donating Jill's time right now, or are they being paid some?
Each board is paying $7,000 to the city.
So see, each board right now is paying $7,000 to the city, and that's part of those administrative expenses that I had. But if your new administrator is a little more than that, then it's gonna go up a little bit. But it's not gonna go from zero, because you already were paying something as a board to the city. So it will go up because you're gonna have a third-party administrator, but it won't be, a huge issue because you're already paying some.
And you are already paying $1,500 a quarter for the attorney. That's $6,000 a year.
But that doesn't change.
Yeah, not yet. They haven't increased their fees yet, but the actuary just increased their fees last year. We have a whole new fee schedule for them. So it's the actuary, the attorney, the conferences and things that are outside of normal expenses, and what you pay for liability insurance, and trying to think if there's something else other than liability. There's one more thing that you end up paying for. That's all rolled up into that 2.1%.
Yeah, the median last year was 88.2% funded ratio. But there was, 12 plans in the 50s and 60s. And, we have some plans that are 100. So, there's a range, but you guys are in that range.
I got a question. Excuse me. So we increased our staffing like a year ago to 3 more members, which we haven't hired them yet. That should significantly improve some of these numbers as far as for contributions.
What helps is page 13, remember how we have that mortgage payment, so that 2.7 or 270,000 or whatever that we have, that we're paying for the unfunded actuarial accrued liability. So, that's a dollar amount, right? It's a fixed dollar amount. So it's 270,000 this year. It might go up or down this year, but relatively it's a dollar amount. So to get the percentage of payroll, you take that dollar amount divided by your payroll. So right now your payroll in this valuation was $1,506,000, was the payroll that we had. So if you hire 3 new people, that's another 150,000 in payroll or something, right? So now your payroll is going to be higher. And so that 270,000 divided by that higher payroll is now a smaller percentage. So that 20.4% of payroll for the unfunded actuarial accrued liability payment might go to 19% of payroll next year. You know, if you hired more people.
Right.
So that's really where it helps. It doesn't really change the normal cost, you're still contributing for their pension and all that. It really just helps in that one spot, and the administrative expenses also. So again, the administrative expenses are $1 a minute. So that 2.9% of payroll there, if you had a higher payroll, it would be 2.5%. So both of those two lines there, adding members helps.
Thank you.
To add to that question though, would be, was this valuation figured on 25 or was it figured on 22?
22, you know, it's always whatever's there on the valuation date. You know, next year it might be 25 or 26, but this is based on, we always do a snapshot, that's all we can do,
Yes, sir.
you know. And things catch up the next year if it was out of whack.
I think the difference in that 82%, you know, another kitchen fund is 100%, just body department, that big difference.
Well, there's a lot of issues. It could be the benefit level. I mean, you know, if in general, employee plans are on this list too. It's not just firefighter pension plan. If I limited it to fire, it would probably be lower that, because on average firefighters have less turnover. You guys had a lot this year, but in general, firefighters tend to stay. And general employees and even police officers have more time. So for the pension plan, if everybody makes it to retirement, that's a difficult thing. It's more expensive, right? If everybody left after 4 years, you'd have 100% funded ratio. You wouldn't need to put in any money. So that's the biggest thing probably is the fact if it's a fire or a police or a general. Some of it is the benefits. Some of it is how recent benefits were changed. You know, if you had a 2.5 multiplier for 50 years and then you increase it to 3%, well, now all of a sudden your liability went up immediately and your funded ratio goes down. But you're going to pay that off over time, right? So that somebody who did that same improvement 20 years ago has already paid it off. So there's a whole lot of issues as to why the funded ratio is higher or lower. But, you know, that these boards meet all the time and do their investing, and then we tell the city how much they need to contribute. And as long as they keep making those contributions, then all the plans are essentially 100% funded, because the city has to make the contributions to make it actuarially sound. Does that help?
Do we need to accept the evaluation report or? Yes.
I believe are we setting a rate of return as well?
Yeah, that's a separate motion. So the first motion would be to approve the actuarial evaluation report.
We can make a motion to accept the evaluation report.
Motion by Sugden,
Second.
second by Mr. Lenity. All in favor?
Aye.
And then, as Jill pointed out, every year after you get the valuation report, you're supposed to declare an expected rate of investment return for the next year, the next several years, and the long term thereafter. Which is kind of silly because we already do it in the valuation report, but the state a long time ago asked that you do the separate motion. And I'm comfortable with 7.4%. I don't know how Burgess feels.
I would declare an expected rate of return of 7.4% this year, I mean, next year, over the next several years, and over the long term.
It would remain the same.
Correct.
And I believe a letter needs to be, Jill, are you gonna handle the letter? Okay, thank you.
And so we would make a motion to accept the valuation at 7.4, the expected rate of return.
Motion.
Lindy, second by Sugan, all in favor?
Since you guys have the valuation report and transition to the next topic, if you go to page 39. So I talked about, the benefit level to the previous question, and so, you guys have, for a normal retirement, it's earlier 50 and 7, so it's basically 50 and 7 or 25 and out. And the benefit is in two pieces. You guys have, it's a 2.5% benefit accrual rate, which is what the general employees have. And then you also get this additional benefit. Right now, it's 0.65% of average final compensation times credited service. And that additional benefit, additional above the general employees, is being paid for with state monies. You guys are getting state monies every year to provide additional benefits. And a long time ago, even I've been working for Foster & Foster for 26 and a quarter years. And when I started, you guys already had this process in place in the ordinance where every year we look at the state monies and the accumulation and the earnings of the state monies. Then we look at the extra benefits that have been provided, and we say, okay, what extra benefits can we provide going forward? And so we've done that calculation ever since I started, and conceptually, it's very nice in that, you're getting these state monies to provide extra benefits for the firefighters. And you guys have a general employee plan. So it totally makes sense to use those monies to pay for an extra benefit for the firefighters. That's the concept, but that isn't necessarily how it has to be done. You talked about this comparison with other municipalities. Well, on this list of 217 plans that we have in Florida, which maybe 170 of them maybe are police and fire plans. Of those 170 police and fire plans, Palatka is the only one who has that exact structure, that you guys have with handling state monies in that way. So it isn't that it's a state mandated, you have to do it the way that you've been doing. It's a nice way and it makes sense, but it's not required. It can be negotiated to be something different. So that's why that's the transition into the next thing. And I brought with a handout. Yeah. It's also in your packet, I believe. But what I did is I basically started by giving the state law preamble or whatever that just describes that these state monies are supposed to be used to provide adequate retirement benefits for the for the firefighters in that city, in Palatka in this case. And then it also outlines minimum benefits in the state law, which is a 2.75% benefit accrual rate right now. And they have to have 55 and 10 and 10-year vesting. You know, it has different minimum benefits that have to be done in order to get these state monies each year. And then I show the current structure down at the bottom of the current plan. So this is your city ordinance, you know, the laws of the city. And so that's the section that talks about 2.5% as benefit one, and then you get an extra benefit, a 175% benefit each year. And then if you go to the second page at the top, you know, one issue that we have, that we've always had with this, which can be good or bad, but it says the redetermined percent shall be applied prospectively to the retired members and beneficiaries of deceased retired members. So basically, you know, it changes the retirees' benefits. And so that's even more unusual, you know, of the plans that I deal with. You know, usually when someone retires and they're gonna get $1,000 a month, you know, that's what they're expecting to get every month. So again, mathematically, this works fine. So do it every year and adjust the retirees, but it may not be the best practical solution. So the next little section here is basically showing part of our calculation that we do each year. So first of all, we accumulate all the state monies that you've ever gotten, right? And then they get earnings, whatever the plan earns. So as of 10/1/2023, that was $7.2 million that you've gotten from the state, at least since we started tracking this, with earnings. So, you know, that's a real nice thing that's happened. You know, we've gotten $7.2 million in accumulated state monies with earnings. And then the second column is, but we've already paid these extra benefits to people, right? We've had people who've been retired for a long time, and they've been getting that extra benefit, that 0.65 multiplier. So the accumulation of all the extra benefits we've paid with earnings is 4.6 million. So basically we have 2.6 million to pay for benefits, you know, that are going to be, because those retirees are going to continue to get that. And then future retirees are going to get that. So that's 2.6 million. So you can see that in 2020, it was 2.7 million. And at that time, the multiplier was 0.79. So you were getting 3.29% multiplier. And then in 2021, we had a good year, right? So that on the left-hand side, that accumulated state money went from 6.6 to 7.9. So we had a nice improvement in that state monies. So we said, oh, now we can increase that 3.29 to 3.35. So it went from 0.79 to 0.85.
And just for clarity, that drives up or down the benefit that our retirees are
Exactly.
receiving each month.
Exactly. And we always do it 1 year ahead there too. But so yeah, so 10/1/2022, all the retirees got a raise, which is a nice thing, you know, and so then, but then we hit 2022. So 2022, now your accumulated state monies are back down to 6.6 million. And you guys have gotten raises that year also. So the liabilities went up, and our accumulated state monies didn't. So we had to reduce the benefit that year, which took effect a year later, 10/1/2023. And then this evaluation, the one you guys just approved, remember you had like 7.7 or something. You had just above your assumption. So when we did that analysis 10/1/23, the multiplier actually stays at 0.65. So for next, on October 1, 2024, there's not gonna be a change to the retirees' benefits, up or down. So that's where we're at right now, you know, under the current structure. Does everybody understand how that works? So some things I thought of for changes, if we wanted to change it. One thing that would be easy is that, you know, in the 26 years I've been here, we use the market value return, you know, whatever the plan gets, that's what we apply, right? But for the valuation, for funding the city contributions and such, we use that smoothing technique, right? And we started over that smoothing technique 10/1/2020 for the year ending 9/30/21. You remember, if you're looking at the valuation report, it's on page 32. So we've basically been smoothing for 3 years. We had 21, 22, and 23 that we've been smoothing. So if we said, okay, let's use that smoothing assets for purposes of this calculation, where we determine the new multiplier for everybody. So if you look on page 3, then that's the history on the left-hand side. Go down one. Right there. So the left-hand side is the actual history using the market value. So remember, we were at 0.79, and then it went up to 0.85, and then it went down to 0.65, right? And that was based on the market value of assets. You know, that has a lot of volatility, which we see there. If we use the smooth value, it actually would have stayed at 0.79, 10/1/2022, and then it would have went down to 0.75, 2023, and down to 0.7, 2024. So just like the valuation, that 22 loss is going to be spread out over 5 years. So, you know, this chart is incomplete here. If we use the smoothing, it's probably going to go down again 2025 and 2026, you know, because we're still going to be recognizing some of that. But I think that that would be better probably than the current method, you know, because for the same reason we smooth it for the city's contributions, we don't want the members' benefits to go way up and way down each year. So it would make sense to use the smoothing. And we probably could do this retroactively if the board wanted, and, you know, and then apply it. So when the members went up 10/1/2022, you know, if they were getting extra $100 a month, we could kind of take that back now. But then in 2023, when they went down to 0.65, we could pay them back that extra. We could make them whole as if we had been using the smoothing, or we could just start smoothing going forward, but that's one possibility.
Question. So if we started that smoothing now, if we retroed that smoothing, what would it, does it cost the pension? Does it cost the city? What does it do to our pension? And then that would give them some relief as it stands. And then we could look at other options.
Yeah, I mean, you could do this option first, use that smoothing instead of market value, because that's not in the ordinance. That's just a method that the actuary has been using, right? So kind of like when you guys vote on assumptions and methods in the valuation report. That's something we could change now, and it doesn't have to be done by ordinance. So it could be done today if you wanted. And it would cause a little bit of an increase in the city's cost next year. We wouldn't redo this valuation report or anything, but we might be giving them some money, these retirees. So maybe we give them $5,000, you know, from what's happened before. Well, then when we do the 2024 valuation, there's 5,000 less in the plan, right? And so that'll be a little bit of an actuarial loss. But that smoothing is gonna probably make the retirees' benefits go down a little bit each of the next 3 years, right? Because we're gonna recognize that 2022 loss. So it should be a wash to the city, a wash to everybody, really. Yeah, it doesn't change anything in the long run. It just smooths it out so that the members don't have a big increase and then a big reduction and whatever. It's just a smooth increase or reduction. So it shouldn't have any negative impact on either the members or the city in the long run. It's just that it's gonna provide a smoother ride for the members. It doesn't, it's not like we're all of a sudden gonna give them extra, you know what I'm saying?
I don't, so they're gonna continue to feel the hurt for the next 2 or 3 years regardless, whether we smooth it or not.
The 26 loss was a big hurt, if you wanna describe it that way. So it was a big hurt. And what we did for the retirees and the active members is we said, okay, we recognize, well, for the valuation, the funding valuation that we talked about a few minutes ago, that one, we spread out that hurt over 5 years, right? So the costs went up a little bit last year, they're gonna up a little bit this year, up a little bit next year, the city's funding. So that hurt is being spread out over 5 years, right? Does that make sense? And so, but what we did with the retirees is they got that hurt all at once. So they went from 0.85 down to 0.65. So their benefit went down immediately. With the smoothing, their benefit would go down gradually. So if you look at the right-hand side of that chart right there, instead, they wouldn't have even gone down at all 10/1/2020, or they wouldn't have gone up 10/1/2022. They would have only went down from 0.79 to 0.75 the next year. And then they would have went from 0.75 down to 0.70, 10/1/2024. And depending on what happens, you know, they'll probably go down a little bit in 25, 26, and 27, because we're still gonna recognize some of that loss from 22, that hurt is being spread out over 5 years instead of immediately.
And so if we don't smooth it, are we still looking at that number going down over the next 3 years? 24,
No,
25, 26?
this year and get 12%, right? Then that left-hand side, the way we're doing it now, that 0.65 will go up. You know, it might go to 0.7 or something,
Pulls them back out.
right? But on the smooth side, it'll probably stay at 0.7 or maybe even go to 0.65, because we're gonna spread in the 2022 loss with the 2024 gain. So it in the long run, it doesn't change. We're still gonna recognize that loss in 22, and the gain that we get this year are still gonna be recognized, either immediately up and immediately down, or it's gonna be spread out. And so it doesn't change the long-term picture. So you can see there that, you know, in 2022, the retirees were higher. In the smooth method, they would be lower. In 2023, they were lower. In the smooth method, they'd be higher. And so instead of going like this, it goes like this. it doesn't change the total in the long run.
That's year 5. We have a banner.
Well, see, if we had exactly the 7.4% for the next 5 years, then you wouldn't have any. You wouldn't have, you would still be recognized, it would take 3 more years to recognize that 2022 loss, and then you'd be stable, right? But so if we had a big gain this year, that's gonna be spread out over 5 years also. So for the next 3 years, this big gain would be kind of washing out that 2022 loss. And then in 3 years, when we're done recognizing that 22 loss, the benefit would go up. Because we'd have this 2024 gain that we're still recognizing part of. Does that make sense? So there's just, it's always rolling, smoothing. So if we get good returns for 5 years, it's gonna just keep getting better. If we get even returns, it's gonna stay flat. But right now, we're recognizing that 2022 loss. So if we use the smoothing, there's gonna be 3 more years of that, recognizing some of that loss. But if we get a gain this year and we don't smooth, the retirees are gonna get a benefit right away. If we do smooth, it's gonna be gradual.
Do you have any idea what the, like, 20 basis points there that it changed and dropped? Do you have any idea what that equates to for an average?
The issue is how much of how significant to the members was that 0.2 drop, you know, from 0.85 to 0.65. And let's see. You know, maybe like $180 a month is a really total rough guess, you know, on the retirees. Some get more, some get less. If you're getting a bigger benefit, then you get a bigger hit. If you're getting a smaller benefit, it's a smaller hit as $1 a month.
For some of our members, it was pretty significant. A few $100s a month, so pretty significant.
Right. So that leaves me then to the second alternative. Okay, so the first alternative, like you said, we could do regardless if we want to. The second alternative, and like you said, with that first, maybe we don't want to, because if we're getting a good year this year, and the retirees are used to that 0.65, now they're gonna get a bump next year. So, you know, it's not necessarily a right or wrong answer for the smoothing technique. It's just an alternative way to do it. So then the second alternative is to freeze the retirees. Okay, so if you go back to the previous page that has that little chart in the middle that shows, you know, our calculation. I'll go up 1 page from that. Right there. So our calculation says, okay, we've got these accumulated state monies and we've paid out benefits. So we have 2.6 million to play with for the future, right? Which is higher or lower than the year before. Well, if we fix the retirees, then any up and down on that delta there, we're gonna have to spread out over the active employees, right? The retirees aren't gonna go down anymore or up anymore. So if we have $1 million that we have to spread out, we were spreading it out over the retirees and the actives. Now we're just spreading it out over the active employees. So there's going to be more volatility for the active employees, but we could keep this exact methodology, you know, concept where we're gonna look at these extra state monies every year and see what that can buy and over and above the general employees, so we could keep the same structure. But then if someone retired, they would know that's their benefit for the rest of their life, which is a good thing if you ask me.
But when you say there's more volatility for the current employees, meaning that when the state monies go down and the drop goes from when the calculation goes from 329 to 331, when they retire, their retirement would be at that 3.1.
Exactly. So if you go to the page 4,
So and then the retirees would be set at whatever number we pick for the current retirees, but for our active employees that retire, whatever the multiplier is when they retire is what they will receive for the rest of their days.
exactly, exactly. So, and so the top of that page, I redid the calculations as if we had been doing it that way, starting in 21. Because that was the first year we had changes, so, the current method there on the left went from 0.79 to 0.85 to 0.65. Well, what would have happened if we had been using this technique? The retirees would have stayed exactly the same, 0.79. Their benefits wouldn't have changed. But then we had that good year, right, in 21, that affects the 10/1/2022 benefits. When we're looking at the active employees, they would go up 1.1, above the general employees. So it would actually be a 3.6 multiplier if somebody retired between 10/1/2022 and 10/1/2023. But then now we had the loss, right? And so now that 1.1 would come all the way down to 0.45. So if somebody retired between 10/1/23 and 10/1/24, they would get a 2.95 multiplier. And then that would be their benefit the rest of their life. So the way you described it, somebody retires, it's going to be whatever the multiplier is when they retire, which is going to change more often now if we freeze the retirees. But again, that's something. Now that would have to be done by ordinance, because right now the ordinance says retirees have to go up and down each year. So that would have to be negotiated and changed in the ordinance. And then the last chart there is, well, what if we did both? We did the smoothing and we froze the retirees. So now everything is the most stable it can be. See how the retirees would stay obviously at 0.79, and then those actives would have less of a volatility because we're using that smoothing. So they would went from 0.79 to 0.9 to 0.8 to 0.65. And likely the next 3 years, it'll come down a little bit more, depending on how we do in the investments. Does everybody follow me so far? I know that's a lot of information.
You guys have more questions? Yeah, I have another question. I'm asking a bunch of them, I guess, but
One thing I heard that I don't like is adding to our mortgage balance. What's the other of that happening?
Oh, no, when I said, if we retroactively did the smoothing, we would be paying those retirees a small amount. I didn't do the calculation. But let's say it's $5,000, to this plan, $5,000 isn't a huge amount. So we pay them $5,000 now. So our unfunded actuarial accrued liability would go up by $5,000. But then the next few years, their benefit would be going down, right? Which reduces our unfunded actuarial accrued liability. So we'd have a $5,000 hurt right now that would be spread out, and then we would have a gain the next 3 years when we give them those reduced benefits because of the smoothing. So it would be 5,000 now and then maybe a 1,500 gain next year, 1,500 gain the next year. So it would not be overall increasing our unfunded liability. It would just be a timing issue. Does that make sense?
So then the other question I would have, is that, is there a way to fix the multiplier for both current and active employees across the board?
Yeah, I mean, so then now we go to alternative 4, which is what 98% of those other plans in Florida have. Well, maybe 85% have a share plan with the excess state monies. So in those plans, the benefit is fixed. So their multiplier does not change. So if it's 3.15, let's say, you know, our current multiplier, that wouldn't change ever unless you guys do like negotiations and you work with the city and you agree, the city says, okay, we'll increase the multiplier, or the members say, we'll do an extra 3% member contribution to get a higher multiplier. So, you know, whatever, that multiplier can be changed, but it only is done through negotiations. The ordinance now would say in the ordinance that the benefit is 3.15%. It wouldn't say 2.5 plus some fluctuating amount. It would say 3.15, and that would be fixed for eternity unless you guys negotiate some kind of a change. That's the way it is with almost all of my plans. Both the actives and the retirees are fixed. And then with state monies, you know, if right now the state monies are covering that 3.15 multiplier, that's what I've done this calculation, right? And I've said, you know, this is what the state monies can buy is an extra 0.65, right? So that's what they can buy. So if we get increases in state monies, what do we do with that? And so there's a share plan. So they're sharing in 2 ways. One is you can share those increases with the city because payroll's going up, the cost of the benefits going up. So they want to take some of that to pay for this 3.15 multiplier that you guys have. But some of it can go into a share plan. So in my example, you know, right now you guys got 71,357 last year. That was what you got from the state. If we get 81,000 this year, well, now you got 10,000 more, right? So let's say that could be split 50-50 with the city. That's what a lot of our boards do. Or it could be split 80-20 or 0-100, whatever. But let's say it's 50-50. Well, then 5,000 would go into a share plan for the firefighters. And that money would kind of like be accounted for separately. And it would be kind of like a defined contribution or a 401k plan, a 457 plan. So that money would just accumulate. The Burgess would invest it, you know, it'd be invested with the rest of the plan. And so if the plan earned 10%, your money would earn 10%. And then when you retire, you would get that money as a lump sum. So that's the most common method in Florida. So the benefits are fixed, the defined benefits, the 3.15. And then there's the share plan. So if the state monies go up, you know, both the city and the members benefit. The state money goes down, you know, you just don't get any money in the share plan that year. But you don't lose the monies that you've accumulated in the share plan.
But we could agree on both ends that all the money could be used. You could mutually consent that the city could use all the monies to fund the pension, or there could be a split.
Correct.
How long could they leave it in the share plan? After they cease employment?
I mean, generally we like to have them take it as a lump sum. I mean, there are plans that allow them to leave it in like kind of a post-retirement investment account. But, you know, this plan is provided to provide a retirement benefit, not to really invest other people's money. Like if they have $100,000 in the share plan when they leave, I mean, we could keep it in the plan and provide that we'll invest it for them but that's not what most plans do. It is possible, but generally we don't. Generally, we give them to them when they leave and they can roll it over into whatever kind of vehicle that they want at that time.
So in this share plan, you're showing 3.15, that's based on the 0.65%, because we had a bad year in 22. Like, how would we actually set that? Are you suggesting that that will be, say we do it fixed like that, we go with 3.15, because that's basing it off of 22.
I would go 3.15 because that right now, and way based on the monies that we have in the plan, that's how much we can pay going forward with state monies, right? Is that we can afford to pay the 3.15 multiplier. That's the whole calculation that I did. Before we could afford to pay more in 2021, you know, before we had that loss, but we did have that loss. So now we can only afford the 3.15. So that's what I would set. It goes up to me, but that can be negotiated. But if you negotiate to pay 3.35, you know, what you used to have, if you negotiate 3.35, then I have to do the valuation and do an impact statement and say, now your unfunded actuarial accrued liability is higher than what it was in here. And the city's costs are going to go from 30% to 34% or whatever, you know, then there would be an impact if we did something other than 3.15.
So, but this is a snapshot of a couple of years. For many, many years, the monies were up, right? 3.29, the 0.79 was pretty well standard for about 10 years, right? So would we be better to look at a long-term snapshot of low and high and then take the middle so that we can make a more informed decision?
Well, like you said, you guys can negotiate whatever you want, you know, but actuarially right now, you know, the money that we have in the plan supports the 3.15 multiplier. You could look at other cities and FRS and say, you know, what do we want our multiplier to be competitive, and you know, decide that it should be 3.25 or something. You know, that's perfectly fine. But I'm just telling you that you know, I'm gonna have to do an impact statement. Right now, the city is at 32.2, it would go up a little bit. And maybe that's perfectly fine. You know, you guys should negotiate a multiplier that's good enough for the city from a funding perspective and good enough for the members to recruit and retain good firefighters. You know, that's not really, that's a negotiation issue.
And then,
But on an actuarial issue, right now you can afford 3.1 with the 32% city contribution rate.
understood. Then how do we get those numbers? That's something you would do for us. You would give us a range of numbers.
Yeah, I mean, if you guys talk to the city and the union yourselves and decide, you know, we want to see what it would cost if we do a 3.25, I could easily get you that number.
And then we would just go through Miss Jill to help us with that at this point.
Correct.
Thank you, sir. Yeah, any further questions? Just wait. Mhm.
You thought that a union.
Yes, sir. Yeah, so there's no vote in this case, right? We can just table this into
Well,
next
the one
week.
decision you could make, like I said, is our very first one about the smoothing. You know, you do that in the valuation. We could implement that in this other calculation. So that's something you could vote on if you wanted to, or you don't have to.
I'm not sure how, like, the retirees would you want that raised up or down, or would you want it smoothed out, like gradually take the hits? I'm not sure when I retire how I'd feel about that either.
I just don't like the idea of the retirement getting decreased for the next 3 years.
Is he think it's decreased over time, or it'll decrease drastically and then increase. I don't know, that's a good,
Well,
yes.
maybe because it sounds to me like because of where we're at. It sounds to me like because of where we're at in this point in time, where the multiplier was already reduced. And if we get a good year, maybe it can go up a little. It sounds like you guys would rather just wait on the smoothing.
It's
And
not.
that's fine.
It's not. If we did nothing,
Stays the same.
it stays the same. If it goes up, then we, at least we have a chance for them to recover some. My opinion. Any further questions? Can we move to the next subject? Is it time? Let's go to the mutual consent document.
Is my mic not even on the whole time?
If we could hear you.
Sounded good.
Now it's on, but it wasn't.
Thank you. That was a lot.
The mutual consent document means that you're going to continue to use the state monies as it has been in the past for the current year.
Do you have any questions? Have any questions on that?
If you decide to continue doing it, then you would need a motion. And I will get the documents for you to sign.
So say we continue it, but then we discuss it with the union and the other guys and we decide that we want to smooth it over or something. Is that counter? Like going against what we just signed? Like do we hold off?
Well, the mutual consent stays until there's a new one. So I mean, you would
We could
just,
change it next
you
meeting.
could change it next meeting, right?
Any further questions? Entertain a motion to accept the mutual consent document as it stands.
Second.
Motion by Mr. Leary, second by Mr. Subin. All in favor? Thank you, sir. Oh, I guess we need to make a motion to accept it all, or we can go on to clause.
You can go on to clause.
Moving forward to Klausner Coffin. Hey, Miss Anna.
Hello. Just a quick update for everyone regarding the Form 1. It will now be filed solely online. I think it used to go through, I believe, the supervisor of elections. So now you will, I believe you should get an email. You'll create your login and then you will just upload your form directly to that site. So just something to keep in mind. Those are due July 1st.
That's their report. That's all they had. Just an informational memo.
Thank you.
Yep.
I'll need a motion to accept these expenditures that were made between October and December. There were some contribution refunds from from current employees who resigned, and just the normal pension payments. As I was talking about earlier, you see the expense for the plan administrator, for the liability insurance, and for postage and supplies, because we do end up sending multiple letters to retirees over the course of the year, to all retirees multiple times. Those are the amount of money that goes to offset the city's expenses.
Have any further questions?
Motion to accept the quarterly expenses.
Motion by Sugden. Second by Leonard. All in favor? Public comment? Sir,
Well, there, stay here.
please come up.
Hi, my name is Vito Russo and I live at 415 Nimitz Street. That's my first meeting of the pension and I got a big learning curve and I got a couple of basic questions. Number one, this smoothing technique, this is a 5-year moving average that we're going to employ as it moves forward. So we're going to project out 1 year in advance after another using the previous 5 years.
Essentially, right, it's a 5-year recognition, yeah, rolling recognition, right?
So 20 to 2024 would be projected for 2025. And then the very following year be 2021 to 2025, projected 2026.
Well, the projection part is the whole valuation. So when we determine the funding requirements, it's always for 1 year later. That's the projection part.
It was mentioned that if we shift over to the smoothing technique using this 5-year moving average, that some of the pension benefits would reduce like by $200 a month. Is that correct?
No. The benefits did reduce in 2022. Everybody's retirement benefit went down because of those calculations. And one of the audience members asked, in general about what effect that was. And so I said like $180 some a month on average, maybe, but that did happen already. If we used the smoothing technique, then the benefit reduction would have been different,
Less.
less of a reduction.
Yeah.
But the reduction would be recognized. It would now happen over a 5-year period rather than immediately in 2022. So that's what we were talking about. Do we want to change to that or not?
Okay, I understand that. These different, I'm curious, the impact of the city's budget on these different options. The smoothing technique, try to get a better sense of the impact on the city's
Well,
budget.
none of the options in that letter, in the side letter, the
one-
scenarios that we're looking at changing.
Yeah.
None of those have any current effect on the city's funding requirements. They're all just ways we could change methodology in the future that wouldn't have any effect on the city's funding. They would still be using those state monies to give benefits to the firefighters. It would just be in different ways. So it would not affect the current city funding requirements. Other than that small, if we were to do that retro payment to the retirees that we talked about.
Currently we need to hire some more firefighters. So my question is, as we increase our hiring of firefighters, what's the impact on these unfunded liabilities? It goes up or it goes down?
Well, when you hire a new firefighter, they don't have any unfunded accrued liability. They have no accrued liability when you hire them. So it doesn't increase the unfunded actuarial accrued liability, but it does increase the payroll. So that's what we mentioned earlier, is that now we have some of these fixed payments in the valuation. Now we have a bigger payroll, it'll be a smaller percentage. So it can help reduce the city's costs as a percentage of payroll if you hire new firefighters.
Okay. And my last question is, what's the repercussions of these seriously unfunded pensions? Like you mentioned, some cities have 60%. Their liabilities are way exceed their assets. So what's the repercussions of having a situation like that? I believe the state of Illinois is that way. I think that their pensions.
The difference between Illinois and Florida is that we have a state law that says every year when I do this valuation report, and it says that the city needs to put in 32% next year, they're legally required to do that. In Illinois, we do work in the state of Illinois, and when we do a valuation there, they always had a choice. we'd tell them, hey, you should put in 30% of pay, and they might put in 10% of pay. So that's the big difference. And so, right now, the repercussion of an unfunded plan is that the city has to make higher contributions to make that up. And so that's the repercussions now, but it's not that, we're not going to take away benefits other than this issue that we have here. But generally, we're not going to take any benefits away.
So the Florida law is there's a certain minimum percentage requirement, assets to liability. Is that the case?
Well, the state law says that the board has to hire an actuary like me to do evaluation and determine how much the city should put in. And they have to use reasonable methods and assumptions. So that's what this report is. And we determined for next year, the city needs to put in 32% of pay. So it's a requirement that they have to have this valuation report done by an actuary, and then they have to make that contribution.
They're required to make that contribution. It's not an option.
Exactly.
Oh, all right. Thank you.
Is there anyone else here for public comment? Seeing none.
Make motion to adjourn.
Motion by Lindy.
A second.
Second by Sutton. All in favor?
Aye.
Aye.
Was
Thank
that
you.
enough actuarial talk for one?
Thank you. It was good.
How are you? Please remember, we're still being recorded. All conversations are still being recorded because we're moving into our luncheon meeting now.
Okay, so that.
Hi.
Good man. You know, he's a man.
You know.
I mean, I'm just trying to say that is. Yeah, no, thank you. You're very.
I'm not knowledgeable. I'm trying to learn. I'm trying to.
Oh, you're doing well, very, very well. Yeah,
There's a lot.
you ask very pertinent questions too.
They're not Christmas presents.
No, thank you. So to summarize again, this is for the response to the RFP that was put out by the pension attorney, Adam Levinson. And the Resource Center is going to do a presentation for the board members to consider.
And can you confirm this was the sole respondent?
This was the sole respondent.
Okay, with that said, I think we can move directly into your presentation.
Good afternoon. I'm glad you all had a chance to get lunch first. My name is Scott Bauer, and I have members of our team with me, Kyle Tintle and Joseph Rivera. And as we get started, I just wanted to say that we're really delighted that we're here, and I wanted to thank the different boards for having us. So as I go through this, I'm going to not try and take a long time. Typically, when we do these presentations, we spend about 20 minutes. Part of that I want to spend on who we are as a firm, part of it on how we do things and what we do, because as a boards, you would need that kind of assurance in terms of how we would be a fit for your members of your plans primarily. And that's very important to us. So again, we're just very delighted to be here. And I do want to thank everybody. The presentation on the screens will mirror what we go through. But if we go over to the next page on the presentation, you know, if I could spend most of our time in terms of a presentation, I would really spend it on talking about who we are more than I talk about what it is that we do. And the reason for that is we've been doing this for a long time. So we understand all of the aspects of plan administration very well. I've been doing nothing else for 30 years. And I know that Jill is retiring. And from what I have heard, those are going to be big shoes to fill here because I have heard just good things about her from different people. So I do want to give you that kind of assurance that we do understand the different tasks that the board would be requesting from us in relation to plan administration. But more importantly than that, what I really want to tell you is that when we do the plan administration, and we'll talk about systems and resources and how we use those things, what we're really here talking about are the members of your plans. And that is, in fact, what is most important to us and how we go about doing the things that we do. It's really not about all of those other things, though those other things need to be happening with some competence. It's about the people that you work for and represent as trustees on these boards. So I can tell you that we care very deeply about the people that we work for. We're not so big that they are just anonymous numbers or people to us, but they're individual peoples at important times of their lives, particularly when we interact with them from our office. So if I could impress upon you one thing, I think that would be the thing that I'd really want to tell you about who we are more than I care about the things that we do. But if you go on to the next one, in terms of what we do, just briefly, I will talk about two different sides to it. When you talk about plan administration, and I'm sure that there are things that Jill does and other people in the city do in relation to these plans that the boards probably don't see all of those nitty-gritty details from day to day. But when it comes to the plan administration, there's really a people side and an information side to this job. The people side really happens at the level of the board, all the way down to the individual members of the plan. And the information side goes from the level of the plan really in a similar way down to the individual benefit that will be earned and paid to each person who's a member of the plan ultimately. So we can talk about that people side and that information side and how we deal with those different things. You want to go to the next one. When it comes to the boards, there's a certain amount of administration in terms of the meetings and other tasks related to them and running them effectively. And as a trustee, those are the things that you guys see most frequently and most often, and they're most visible to you. in terms of how the benefits and operations and coordination take place between all of the different people that you employ. And again, if we're talking about it on the people side of this plan, that extends all the way down to that kind of communication and interaction that ultimately happens with the individual members of the plan. So that becomes, I think, again, for us, probably the most important part of what we do in terms of how we try and fill the role that you would assign to us if we have the pleasure of working here. If you want to go over to the next one. I will tell you that the information side is equally as important, and we're very, very adept at how we manage the information related tasks. And again, those happen all the way at the plan level, from things like the plan record keeping and the financial statements and other things that become part of the plan and part of the reports and processes for these plans annually and continually. But all of that then, again, extends down to the individual member and the record keeping of the individual member. And now that we use different kinds of systems, and mostly systems that we have owned and grown over time to assist us with some of these, what I'm going to call record keeping tasks. It's tracking down to the person every last penny that belongs to them, the benefit that they've earned, and ultimately the benefit that gets paid to them. So we can manage and do have the competence to manage that information side as well. Sometimes that information side, by the way, is more like your proverbial canary in a coal mine. When things break down, you will see it happen and really manifest in two ways first. One is that sometimes there's a breakdown in communication, and you'll also see sometimes a breakdown in the information that's used and kept, particularly as it tracks to the members. So sometimes when things go wrong, those are the places where it shows up first. And I can promise you, if you do this long enough, you will encounter those things here and everywhere. It's not that you will never stay free of issues as you run these plans, because these plans are dealing with people and they bring all of their stuff with them. And you have to deal with all of that on the administration. It's not preventing, in every case, some of those things from coming up, because they will. It's really how you deal with them when they do come up. And that's why you're here really as boards, because that's part of what you do. If you want to go to the next one. If we turn over to on the books, it's probably, I've really covered most of what I'm going to call the record keeping. I don't really want to get too far into those record keeping tasks, but they're really a significant portion of what you're hiring somebody to do. So the competence has to be there. But if we go over to page 7 in this handout, I want to really introduce Joseph Rivera, who's our client service manager, and talk a little bit about the communication part with your members, and Kyle ultimately with some of the boards, and also how we do that and manage those tasks within our office.
Good afternoon, everyone. Thank you for having us. So as Scott was saying, as part of the members, when they contact us and they have questions, we have a team that really responds to them immediately. We're a team of 5 that answer phones, questions, processes, estimates. What am I looking at? And then 5 years from now, 10 years from now, what do you suggest that I go into the drop, or what are my benefits? Things like that. We turn around and give them the answers immediately. These are life-changing, situations where, they're about to retire. It's a big step. And we try to make that as seamless as possible. We do it in a matter of a couple of ways. We do have the technology where we track processes as well, where members will get they'll get notifications as the process goes on, automated. But not only that, more towards the kind of the person-to-person relationship. Technology is not everyone's forte. Not you guys, I didn't mean to. But we strive and making that bond with the members. Speaking to them on a personal side of what they're doing for the rest of their life. And as I tell members, once we end the call with them and they're satisfied and they're eased on what they're going to do in the next step of their life, we're here as we're going to be part of, we're going to be friends. We're going to have a relationship for the rest of their life. So they can reach out to us for whatever they need. And we have that staff to provide that. Once, like I said, we have the technology where they'll be able to go online, see statements, try to run a calculation on their own. If they have questions, obviously they contact us and we'll provide that ease for them so they can make that decision or not second guess themselves, but get more concrete information for them. Our staff is there throughout the normal business hours, like I said, and by email, phone, and we provide that service to them no matter what. So, on my side of on the fence, they're a priority all the time. And I manage that department that way. Okay.
On one of the things on that
Can't see it,
page, on page 7 of the presentation, I just wanted to note for you is that when we use technology, we look for ways to use it to create engagement with the members, not to replace engagement with the members. So, for instance, when somebody starts a process, what we're talking about is their benefit and making an application, whether it's retirement, they're taking a distribution or a refund or some other kind of question that comes up, where you're really using that technology as a way to add additional engagement with the person so that they know what's going on. So I would call it something like a package delivery system. As we move things through a process, if we start an application for somebody to retire, they're going to receive a notice from us that we have their application and it's in process. When we receive the data that we need, if we're not getting it continuously, we'll let them know when we have that, when we can then turn it around to Patrick's team for a final calculation, when we get that back, when they should receive it, when they should get paid by Capital City, to when they should receive their first check. So if something happens and there's a blizzard in Topeka, Kansas, and the package gets delayed, they can get a notice and say, wait a minute, we thought we were going to be finished here, but your new delivery date is over here instead. And they're always welcome to talk to us and call us, but it's an additional way, because when people go through these kinds of processes, they do it one time in their life, and there's a lot of insecurity that people have as they walk through it. They just don't do it all the time. And so we want to create those ways to interact with them and to let them know what's happening as they step through it themselves. And we try and do that in all of the different ways that we can. If you go over to page 8 on that presentation, what you were seeing on page 7 was actually a view of the systems that track the communications and processing of benefits. So even if I were here and you were to ask me what's going on with a particular person, I would just pull up that person and see the train of communications to see where things are at and what we might be waiting on, if we're waiting on something. And a member of our team can do the same kind of thing. And we're expanding that to give members secure access to their own information as well. Right now, we include our systems and online systems to the members, and that's included with what we provide as a quote. Provided we can get historical information from the city, we will provide those additional services automatically as part of what we do to the members. So that's usually a process with the city, but not an overwhelming one. It depends on their payroll systems and how well and how easily, but I can tell you we're very adept and agile at being able to deal with things that we get from different places and different formats and working with that. So on page 8, you'll see some of the other kinds of things that we do. These may seem like specialized kinds of things for your plan, But some of these things we do on a very large scale, and then we do the same things in different places on a small scale. Like a board election, if you wanted us to do that online, we can securely. That creates an information trail. We have some very large retirement systems that hire us just to do their elections, and nothing else, whether it's a combination of an online ballot and paper ballot. But we're not so big that we can't deal with Palatka and the differences that your plans had, because they're all individual. But we have enough resources where we can do things and bring those resources to you. And that's really important to us. So it just gives you a little bit of an idea of the kinds of access that the members have to that kind of information. And the page 9, this was the conversation that Joseph had about our internal team. We have different teams internally to deal with data, IT, payments. I know that Capital City makes your payments. We're very proficient at it, not because we're here to do that job if it's being done by somebody else, but we understand the mechanics of it. And typically that's the case. There are different people that have different roles in the places that we work. And so we don't necessarily have to change that unless it's needed. But when we're not doing something in a particular place, even the mechanics of how payments get made electronically and things, we're very, very in tune and familiar with all of those processes because we also do them. It raises our level of understanding. It really, raises and increases our level of confidence in how we're doing the things that you've asked us to do for you. So I don't know if you wanted to say more about the team. You get to page, and I kind of do want to wrap this part up a little bit. If you get over to page, it's hard to see the numbers, 10. The end result of that are really the people that we work for, like I started off by saying. We are independent on page 11. We do nothing but what we do for you. So we don't have any other jobs that we do for the plans that we serve. And that makes us independent in how we do the job for you. I believe in segregation of duties, and separation of duties is an important control if we ever really want to talk about and get into those things. But we are independent, and that adds to that segregation and good, strong controls in place in terms of how we deliver what we do to you. Page 13. So always important. We know how to listen. So it's plan administration is a process. So when things come up, we are here to listen to you and to work with you. And we're really partners with you, because when we talk about administration, the true administration of the plan or administrator or the boards, you just hire us to do stuff and do it on a daily basis. So we're really there partnering with the boards and the trustees and the role that is assigned to you by statute. So unfortunately, that may or may not have been the primary thing you're aware of, but you all are really the administrator at the end of the day. They just call us that. And aside from basic questions, this other handout really details both a summary of the proposal that we made to the board, and also the details typically of how we would have walked through and transition and implementation of our services to you if you did indeed want to work with us. So we're very prepared and able to go through that process. And we do it in a relatively orderly way. I think you have plenty of time. If Joel is planning to retire in October, I wouldn't wait until the last minute. But neither are you under the gun yet in terms of, somebody who's left, and now we have to figure out how to make all of this stuff work. That's actually a much harder scenario. So you are actually really in the best of scenarios to be able to deal with this and to manage some of these tasks from the standpoint of the board, in my opinion. And with me is Kyle. I would like to give everybody a chance to talk, and she should stand up and at least introduce herself.
Hi, my name's Kyle Tintle. I work with several of the communities in Florida. And I'm the one who travels up and down to the meetings and attends that, works closely with the boards. And I'm the one a lot of the time in the office speaking to members from the client service side. They're processing it, but there are some additional handholding that is necessary. I've dealt with widows and divorces, and there's a time where somebody needs to be ready to listen and answer any questions. We've gone to retirement parties and I've gone to funerals for public servants, and it becomes part of family. Like our company is a family to us. The different boards I work with becomes family to me, because it's that important that people have this major life decision, that they don't feel rushed. We make accommodation for after hours, meeting with spouses and the employees. So that's the important part to me, is record keeping and being accessible. So that's the majority of my job, is to attend the meetings and be available for the members and their families if they have any questions at any time. And thank you for the opportunity. I appreciate it. It's a beautiful city, and I'm so glad to have the opportunity to come up here. Thank you.
And I just want to thank you as well. We're delighted to be here and happy to answer any questions that you have.
Okay, so with that said, I think at this point in the process, we'll open up the floor to public comment before we engage in any Q&A and discussion. Are there any public comments? Seeing none. Does anybody have any questions of the sole respondent? And I'll remind the board members in the audience, you too can speak on this item. Just please state your name and what board if you come to the podium.
I guess my first question is to Ms. Gia. Who normally prepares the annual report? Okay.
For the police and fire, it's a requirement, the state.
Right.
Yes.
She's working on it right now.
Anybody else?
My next question is, why is there an extra fee to prepare that report when it's required?
Because we knew that Patrick was the actuary, and sometimes Foster does that task and is already doing that task. Sometimes it's done in-house at the city. So we just don't know in advance. And I could build it in one way, or if we're asked to do it, really estimate for what I consider the time involved in that task another way. And so it doesn't really apply to the general employees in this case. It's just the police and fire that have to file. So it depends on the place where we do it or don't do it. It's not that we're not qualified. We've been doing them for 30 years, and we do them probably about 24 of them annually. I know that Patrick's office is very proficient at doing them, and they do a lot of them. So we're all really adept at the process.
I have a question. You're
by the way, if he wants to do it for $1,500, I'd be delighted to let him go ahead and do that.
For full disclosure, yeah, if we did it, it would be slightly higher than that.
I was hopeful.
you guys are located in Palm Beach Gardens, is that correct?
Yes, sir.
And you'll be conducting these meetings, or someone will be here during those meetings? Is that what I understood? Or
Always.
Okay.
Always.
Okay. You also take care of the scheduling of them, is that?
Yes, we will deal with all of the aspects of the meetings, the tasks that come from those meetings, the operation, the minutes, the communication with the boards, the paperwork. This is a good sample, of what that looks like. I should have brought a meeting packet from another meeting. It probably looks very much like your own. With all of the documents and backup when you need to get here. We typically distribute those about a week to 2 weeks in advance or starting. Some things we get closer to the meeting. So usually once we start sending all of those things out to the boards and trustees, there are follow-up with additional materials that we receive during that time. and posting a public notice. So again, those are all of those things, and I know that you're very, and need to be concerned that we're competent to handle all of those tasks. And if we can spend a lot of time talking about them, but I really wanted to talk about the other stuff too.
I agree. We've been very spoiled having Miss Jill, and this
Yes.
stuff just appears, right? I
Right.
just wanted to make sure it was going to continue to appear.
It's like magic, isn't it?
It's magic.
My question would be for you, Miss Jill. I don't understand everything that you do, so I can read their list and it seems like they do a lot. But from your perspective, are they covering?
Yes, the $600 interim financials. I do financials for all 3 boards every month. I do financials for all 3 boards every month. So I would think you'd want that to continue. There's necessarily going to have to be more an interaction with HR to get the required information. So someone on staff here is going to need to be the corresponding part to a third-party administrator, because they're not going to end up going into our accounting system to get the data that they need necessarily.
And there are a couple of different ways that could happen. Typically, we're going to have some interaction with the city clerk because of your public meetings. We're going to have a bit of interaction with finance or HR as we do what we do. If you can set up to generate the payroll and contribution reports for pension related pay only and pension contributions on an ongoing basis, then for us most effectively, we can use that, for instance, to even give members online access to their own information and calculate benefits if they want to. It doesn't mean that we can't do it for them. It gives them an additional resource that they can have available. If that isn't available, then inevitably what would happen is then we would end up requesting that kind of information person by person when they need to apply for a benefit, whether it's a refund, retirement, or other situation. But we would prefer to have that kind of continual information coming from the city pretty much in an automated way. Sometimes these things can be done automated and done securely, so that when it comes time for reporting to or supporting systems, calculating benefits, reporting to the actuary, completing the annual reports, going through your annual audit processes, we already have all of that stuff. We're not making an additional demand and drain on city resources because we don't have it. We already have what we need to do that. So I will tell you, this plays out differently in different places, but we're very, very accommodating and very flexible in how we get there.
And then Ms. Jill, just one more question. Is there anything in the list that they're missing that we should ask them to do for us that you currently do that they don't have listed?
In the packet that you have is a blue and sheet, a blue and a black sheet of the current administrator's responsibilities. This was within mind that if we did not go with a third-party administrator, how my tasks would have to be divided between HR and finance. Do you do alive and well letters to the retirees?
We do. Some boards do them periodically. When we're making payments, we also use an enhanced, what I will call death search. We euphemistically like to call them verification letters. Everybody has to sign them once a year. But really it's a check to make sure that the people you're paying are still alive. So the answer to that is yes, we do them. And I have them right now in play just in 3 different plans, starting in January. For us, it's usually like what I'll call a 3-letter process. The first round is, you have to complete this. It's a notarized form to send back. Notarized because we want somebody to, if they're not here, to actually see who it is and have some evidence that they are who they say they are. They don't respond, which will be about 10 or 15% of the people. Then there's the second letter, and then there's the last letter. You know, we really, really mean it, and we'd really like to hear from you. And if we don't hear from you, then we're going to suspend the benefit. By the time we get to that point, you guys have had a meeting. There's communication as to who it is and what it is too. So we're not doing that arbitrarily. But we do go through those processes. We did what I would call a large-scale audit of all of our retired members last about 2021, about 3 years ago. And the problem is that, you know, we rely for timeliness. The verification letter, I'm still alive letter, is a once-a-year process. And the death searches that are more timely have a lot of holes in them because they rely on the Social Security death master file. And so that's why we've gone to additional processes to try and have very effective ways to make sure that the people that you're paying are in fact alive when they're receiving the benefits. It may not be as much of an issue in Palatka because the smaller plans generally do a little bit better. And I'm not saying that you're little by any means, but you know, when you have 1,000 retirees or 600 retirees in good faith, depending on the number of retirees, I've estimated in the past that about 0.5 to 1% of the people that you're paying are in fact deceased. And our experience in doing these has borne that out. It happens less when you have 50 retirees or 25 retirees than when you have 500 or 1,000 retirees.
So, Mr. Bauer, I know the General Pension Board had some discussion about what we kind of call white glove service, or the face-to-face interaction that we currently have with our pension members. I'm curious how you guys address that when you have individuals that don't have access to technology or are more comfortable with a face-to-face interaction, and you're not going to be here in Putnam County.
Well, we don't have a local office here, so it's a great question. And I will tell you that it's important not to disenfranchise the members of your plan. And you will have among your retired members both an older population and even among your active members, people who are just not users of that technology to the same level. We do come through here and we do come up here. So for the most part, when we want to sit down with somebody face to face, we're going to do it and we're going to schedule it. You know, and this gets back to the technology. I could even do a one-on-one face-to-face Zoom meeting, but you know, you're going to get that more with police and fire. Some of your general employee members are going to be the most likely not to be users of technology to that level. And we do make that effort to talk to them, to accommodate them, and to meet with them. If it's a last-minute emergency, sometimes there's less time to do that. But if there is time, those things can be done and done well. And it's important to us in how we do that. So when I teach on plan administration, I will tell boards that you're always then dealing with the person who has the least access, not the most access. And I, you know, we work for plans that are farther away. Probably the one I deal with personally most is in the city of East Point, where we have even sanitation workers and public works and other people who have no access to technology. They're never going to send me a fax or whatever even. And we manage it pretty well. And we just, you know, if you had questions about, well, how does that work and how well does that work? I go there myself a couple of times a year, and we have other opportunities where we interact with people, and it actually works itself out pretty well. But if you wanted to, we'd be delighted even to give you people to talk to say, well, how does that work and how does it work itself out? Can it really be done?
Well, no, thank you for the reference. I think that's what we're looking for. So do any of the other board members have any further questions?
Kind of a follow-up on on the face-to-face. Ms. Jill, how often are you face to face with retirees dealing with individuals concerning the retirement plans
Weekly.
weekly?
So we're more scheduled. People who are retired, I'll tell you that these are going to be things that people will take time to get used to. And there will still be some aspect of that that'll persist, because if you have a retired member and they retired from Palatka and they have been walking over or coming over to City Hall for years, they're not going to just stop doing it just because you hired us.
So how are you going to combat that?
So with communication, we'll introduce ourselves, we'll send them a letter, they'll hear from us on an ongoing basis, particularly if you're doing annual verification letters and things. On some of them, in some places, we have created even summary information sheets as additional ways for saying, this is how the plan is doing and what it's doing. Some of the same kind of questions that were covered earlier with Patrick. You hear about bad things in places and you wonder, if I have a pension from Palatka, is that at me? You know, is my plan doing okay? Those are important questions that people have, and you want to be able to give them that assurance. I can tell you that we're just not going to cut people off from City Hall, but we are going to try and accommodate them. If somebody walks into City Hall and they need us to call them, we're going to do that.
So if you were selected in the beginning, would you be opposed to having a physical presence to be able to transition people into that process?
No, I don't. But if we had it on a schedule that's predictable, that would be helpful. If we had work days, we come up here and we do have other places, some other places locally where we work, and we can even, that increases the number of opportunities and days that we're around where we can do that. And we can allow people to schedule those kinds of things in different ways. It's the walk-ins that I'm talking about that are the hardest. But a walk-in can be turned around and we can talk and communicate with them and work out something that's helpful to somebody. But we can, you know, I can tell you when I'm in, and again, I'll use East Point as example. They're up near Atlanta, Georgia, next to the airport. So that for me is a good example because I do some of those things personally. And no matter what my role is in this, I do all of the same things that our team does too. I never stop doing them. And that's important to me. But when I go up there, we have appointments scheduled, and I'm doing that next late in March, and I'll be there for 2 days. And, you know, anybody who's coming up on retirement, it's a bigger city. I will sit down with in 30-minute increments, and I can tell you that they're very, very efficient. But they're not impersonal. So those are two different things. You got to separate the impersonal from being efficient with that use of time. And when we do that there, we schedule people and allow them to sign up for appointment slots online. But yet, you know, there are a few key people that are helpful. Particularly the director of public works up there, who's also on the board of trustees. If one of her people come in, she will help them schedule an appointment online or call us if they need it. So it's, you know, when I say it's a partnership, it really is. And you know, the task and the goal is always not to lose that personal interaction and personal sense with people. We're not huge, by the way. We're 20 people. Not so much that we get lost or you get lost in what we do.
Any further questions?
Yeah, if you'll just forgive the question, but from the other professionals in the room, have you guys dealt with them as a firm? What do you know about them? I mean,
Yeah, definitely. I worked with Scott these 26.25 years that I've been here, and we have a great relationship and they're perfect to work with. So I have no problem.
Burgess will tell you I'm a little less than perfect, but I mean well.
I'm his life coach. No, they do a great job, but we've worked with them for decades and all over the state of Florida.
So if there's no further discussion and
Yeah,
You
and
had
to
something?
Anna too, but to a lesser extent. I've only known Anna maybe for about 5 years.
okay.
Yes, but again,
So
no
Jill,
issues on our
can you
end.
confirm if this combined board meeting was set to make a determination and ranking? And also, would this combined board meeting also be in a position to deliberate and discuss the alternatives to hiring an outside consultant?
Yes, that was the intent, is to discuss the RFP responses and to discuss options in addition to the RFP responses, and make a determination whether to go forward with filling out a final matrix on an evaluation of this firm, and whether to decide, given that we have one respondent, we've talked about a number of options, either going forward and voting, whether to see if we could get other respondents by extending the RFP, reissuing the RFP, because we do have till June, or whether the commission and whether the combined boards would want to approach the commission as far as refunding a in-house administrator, if there's a possibility that that could happen.
Okay, so we have 13 active members combined on the pension boards, correct?
5, 4, and 4. Yes,
Okay.
13.
So what would constitute a quorum is 7?
Yes.
I would defer to Anna on this, but I think each board needs to make an individual decision because ultimately we would be retained by each board individually if you do move forward.
Yes, I would agree with that 100%. Each board will need their own separate motion. So if this is just noticed for one of the boards, if this is just,
Turn the volume.
sorry, can you hear me?
No, Anna, can you speak up a lot? There.
Sure. Is that better?
No.
Hi. Okay.
Jill, it's this smaller screen to your left here. Keep going to your left, the small screen.
Oh, this one?
Yep.
That's frozen. It's
Okay,
frozen
never mind.
all day.
Everybody turn your hearing aids up.
Sorry.
Anna, go ahead.
Each board would need to make their own separate motion in order to retain, if that's what the boards decide to do.
Okay, so Anna, as we understand it, each board decided to hold this joint meeting for ranking the respondents. So we can still do that, correct?
Yes, correct.
So with that said, we have 7 or 8 active board members here. Can the other board members in the audience raise their arms? Mark? You're on a board, correct?
They
Okay.
just wanted to know they each have to do it separately, though. Do you want to sign on? Because they're gonna.
A little bit more time.
Yeah.
The lead, we have Mark Linity, Mark's not here. Mark Linity,
Are you
Ken
muted?
Sugden, and Chad Brightwitz. We have a quorum on that. We have yourself and Mr. Bell and Brett Dennis. So we have a quorum on the general. The police department, we have Scott Mast and Matt Newcomb and James Norwood. So we have a quorum there.
Okay. So would Anna, does that, wait a second. And I guess what we need is direction on if this combined board meeting should just focus on making or ranking and making a recommendation, and not remanding it, but referring it back to the other boards to deliberate hiring an outside firm or going another route, correct?
That's entirely up to you. You're more than welcome to have a vote, to have discussion and ultimately have a vote at this meeting, since all of the meetings were noticed. So you can all, take action during this portion. If for whatever reason, you don't want to make a decision today, then that's a different story. But if you're ready to move forward, then you can certainly do so.
What?
Sure. I think we ought to make a recommendation back to the boards, individual boards, so that individual boards can have that discussion. Because I think there are some things that I still have some concerns and that kind of thing as well, and especially with only being one response to the RFP.
Mm-hmm. So would it be helpful if we discuss the other options to make sure everybody's clear? Okay, so Jill, as I understand it, we've got 3 options on the table. That doesn't mean that there aren't others. The first is to rank and retain a third-party administrator, which we have a sole respondent, the Resource Centers LLC. The second, and these are in no particular order, mind you, is to hire a finance and pension supervisor, which would be your replacement, and assign additional pension duties to an existing HR position. So this is 2 existing positions and then redistributing responsibilities. So that would be very minimal cost increase to the city as well, and probably less cost to the specific boards. And the third is to hire an in-house pension administrator, which you estimated at $71,993 this year, because it wasn't for the full year, and $95,990 for the next fiscal year.
Yes, when you add in all the benefits.
Open it up to everybody for discussion.
Can I, and I apologize for interjecting, I want to stay long enough that I'm helpful, and as long as you want me here, but not so long as to make it uncomfortable for you to have a conversation if you want to do that.
You're welcome to stay put.
I
don't
okay.
have an issue with it.
Okay, then we will in case there are questions.
Thank you.
I wanted to clarify, we did have other respondents that were considered non-responsive.
Ms. Kaiser?
Yes, actually, let the city clerk answer that. Had to stay in this room, didn't I?
Sunny Grant, City Clerk, City of Palatka. To respond to that, I actually did get 3 responses. Unfortunately, 2 came in after the deadline. Per the city's long-standing custom, if you don't meet the deadline, your response gets sent back unopened. So I wrote everybody a cover letter, said, hey, didn't open your response because we received it after the deadline. I also made sure that the tracking sent to both responses indicated that it came in past the deadline.
Does that answer your question, Mr. Bell? Yes.
Any additional questions of me?
No, ma'am. Thank you.
Thank you. I'll go back to my place out there, but I'll be listening.
The HR position, do we have someone in staff now, or that be somebody we would hire?
Ms. Jones, would you like to speak to that?
Sure.
So currently, if those additional duties came in to HR, it would be the responsibility of myself or Mr. Avery, which is the coordinator, which I would definitely have to, get a grasp of the duties coming in and understand them, even if he would be the one actually performing that, because so it'll be both a training module for both of us. But we do have staff in there to accommodate the duties if that's the way the board should decide to go.
Any of the board members in the audience, do y'all have any questions or anything further to add to the discussion? Did you forget to say something?
Yes, I did.
Assuming that's the direction of the city manager.
Well played.
Jonathan, what would it take for us to reopen the RFP so that we can see what the other two organizations had to offer. I understand they missed their due dates, but this is a pretty big decision to me for all three of our boards. And I personally would like to see us look at those options because Jill's already doing the business of probably 3 full-time employees, and so is Miss Jones, and I would hate to put that responsibility on them if we have a good outsourced option. So to do that, you would basically reject the responses and direct staff and our consultants to re-advertise the request for proposals. I think there would be very minimal changes to the RFP, probably address a few things that were brought up by addendum, but most likely, at least in times past when we've had to do something like this, it can be re-advertised within a matter of weeks. I would like to add to that, though, that it's never a good sign when someone can't adhere to a simple deadline and instructions that are typically included in bold and red on the first or second page of an RFP when they're going to be managing a multi-million-dollar pension fund. Yeah, that's a very good point.
The other question I had was what's the transition period? How long does this take if we move this to the next meeting?
I think that's a question of you, sir. I mean, how long does it take to typically get you guys spun up? If you go over to the handout that I had a list and in detail. That's really a 2-month transition. I will tell you that we have done this much faster when circumstances require. And sometimes things that are beyond our control have taken much longer than that, like making a request to the city for data and how long we would take to receive that data, or whether they feel they can provide it in that manner at all. So there are things in there that are subject to change, and we would be communicating to the board, but we've done this really fast, really slow. You have a lot of opportunity here to do it with Jill in a very orderly way. And because she's here until October, I would take advantage of that. You know, it's always a good thing rather than a bad thing. You know, assuming that, let's say you engaged us, and I'll tell you, I'm just honored to be here no matter what. Assuming that you engaged us, then you would probably sign agreements unless you're going to have a special meeting in your May quarterly meeting. So I'm thinking you're towards the end of May. And so you're really looking at a process that would play out over the summertime. Did you have something, Norwood?
Yeah, one of the things that I guess I'm concerned with is making sure that during the transition period that our members, our current retirees are informed of the transition that's going to take place. And they would know at some point, no longer just be able to just walk in and talk about their retirement plans and their benefits and that type of thing, to wherein they would have to schedule but also if we decide to go with this company, that's an important part, because I want our retirees to be comfortable with talking about their retirement plans and having access to that individual in a timely manner as well.
Jill, when is our next scheduled meetings?
June 4th.
And that would be the drop dead date based upon a 2-month transition.
Yes, because then it's August is the next meeting, and that's really late.
Well, I don't want to speak for everybody, but I'm not comfortable waiting until June.
One other thing, I would hope that in Palatka, if a retiree walks in, they're always welcome here. And if, you know, we're not here when they come in, which is the likelihood, you know, it would be simply, well, the person you want to see isn't here today, but, you know, we can work that out or set that up. But I never want them to come here and not feel like this is still their home in some way. I don't want them to be taking up your time, because that's what you're hiring us to do. But I wouldn't want to lose that.
I guess one of the things that I'm very cognizant of is our demographics. And the people in this community, they like face-to-face. They
Mhm.
like developing relationships with individuals that are providing the service for them. And I want to make sure that they understand that that type of service at some point will go away. And I don't want to have them to believe that it's going to be the same, it's going to always be the same and that type of thing. We're going to start that transition period at some point. Then I think the more information that we can give them about the changes that's coming up early on would be better for those individuals.
Yeah, I don't know the geographic demographics of your retired members yet. If that comes to play, we would typically start with a letter, but I'm always willing to think outside of the box. If enough of them are close by and they all still live here, we could even just set up a time and do a meet and greet or something, where they could just come on over if they wanted to. I don't know if they would actually do that or not, but I haven't done that before, but I'm always willing to do something new.
So I have a question for you guys. In the other communities that you guys provide services to, when those communities have their board meetings, their pension board meetings, and y'all staff is on scene, do you ever meet or have you ever met with retirees during or post those meetings? Because it seems like to me this is a simple fix of we notify our retirees, our meetings are posted anyway, and if you guys were willing, if our retirees had questions of you guys, they could talk to you post the meetings. But of course that would be
the answer is frequently, to either meet with people before or after, or the day before or the day after. Or if I were driving to Stark the day before or after I'm in Stark or whatever that is. We're not, I always look for opportunities to do that efficiently because that's how I need to run an operation, but not impersonally. And so, there are ways to make that happen. But we work for you and we're willing, what we would want to do is engage you in that discussion about how to make that happen best. But the answer is absolutely, that would be the place to start.
And Jill, a question for you would be, you said that retirees come in kind of weekly to see you. Are they scheduling appointments with you or are they just stopping in and you're stopping what you're doing?
Stop in unannounced.
This is Palatka.
Well, I know, but I mean, it's almost like we need to change the way we do some of our business so that we're more efficient.
Well, we get that in Palm Beach Gardens too, but probably fewer people from Palatka in Palm Beach Gardens.
But I would say this as well, it's easy for you and I to say that, well, we need to change and stand up. But when individuals have been retired for 20 years or 10 years or what have you, and this has been the norm for them. This is a drastic change for them.
Right. No, I agree.
Can I ask a question again about the HR piece? If we were to decide to go with the HR direction, will this create a new job or this is going to be split between existing staff?
It's not creating.
On top of what you're already doing, you're going to be able to do this and effectively. Because I don't mean any disrespect, not this HR team, but in the past, insurance payments didn't get paid and some things happened that were frustrating to PGA. And again, not to paint you in any direction, but that would be a concern for me.
Well, Brett, I mean, it's a concern for me too, but I can go back even prior to that and say that we had a finance director who also administered the pension, and we had one person in payroll. We didn't have an HR, and we did not have those issues. So it's the staff person. Yes. It's not the number of staff. Yeah. Mr. Levinson, did you have something to add?
Sure. So trustees, Anna has to step away, so you're stuck with me for the rest of the meeting and then the other boards. But I wanted to give a little bit of flavor, and I don't want to prolong the meeting because I was involved with HR or with the city clerk rather to put together the RFP. So I wanted to make clear for everybody some of the context. So number one, not only did I send the RFP to what I call the usual suspects, which is the administrators that we work with in Florida. And can everybody hear me, by the way? Let me ask that first. Can everyone hear me?
Yes.
Okay, so I emailed copies to the administrators who work in Florida, who we know from the various plans we work with. The second thing we did is the city clerk published it in the paper. So it was communicated to the community at large through a newspaper publication, and they could speak to that. And the third thing we did is we contacted the FPPTA, and some of you may know the FPPTA is the Florida Public Pension Trustees Association. And if any of you have not gone to meetings of the FPPTA, then I encourage you over time to look into that. So the FPPTA is the professionals and the trustees around the state of Florida. So it was noticed and put on their bulletin board, which was an electronic bulletin board for FPPTA, the community. So that was the third way that it was advertised. That gives you the idea of how we tried to widely cast a wide net. And the other point I wanted to make is, unfortunately, I was hoping that Foster and Foster, and I like all the ones that we work with, so I don't have any favorites, but Foster and Foster might have been a good fit because, and we could argue pros and cons, because they're your actuary and they also have an administrative arm. Unfortunately, they have a turnover issue right now and they lost an employee, and they made the conscious decision that they did not want to take on new business. And here it would be 3 new plans if they're having turnover and they couldn't accurately and confidently bring in the new clients. So that's why Foster and Foster did not submit a response. So if you were to do this again in a year or a couple years from now, and hopefully if you make a decision, then you won't have to make any future choices in the future. You'll be with whoever you choose. But the point is that Foster and Foster, who normally is at the top of the list with Scott and the Pension Resource Center, made the conscious decision, which I give them credit for, because they didn't want to take on new work if they didn't have the resources for it. And that's an important point, which is that when you hire an administrator, hopefully you'll be with that administrator, and they've got big shoes to fill, as we pointed out with Jill. But they're professionals, they know what they're doing. And the last point is that it takes time to train somebody, and it takes time for a transition, as you were talking about. And the good news is you're taking it seriously and you're asking good questions, and we want to make sure you get those answers. So those are my high-level observations.
So with that said, we're here, we're either going to make a decision if we're going to move forward with a third-party administrator. And if we're not, we need to entertain a motion to that effect too. If we are, it would be simply confirming that the sole respondent is qualified and putting that to a vote. What's the pleasure of the boards?
I did want to make one comment, albeit I'm new to this position and this role. I would say that this is not the only job that Ms. Kaiser does, right? I believe that staff is highly capable of being able to assume the work and responsibilities. However, I would be disinclined at this point in time, being new to the role, to want to move in that direction. I would feel more comfortable bringing an individual who has that knowledge and expertise already as a single individual. That would give us the ability to be able to do the face-to-face. However, it doesn't guarantee that the amount that each of the pension plans is paying now would be the same. So there's no guarantee that would be the same. Like, looking at this proposal represents approximately a $5,000 increase per pension plan. And there's no guarantee that that's not what you would experience if we were to go out and hire another individual to be on site and to do this on a more or less full-time basis. So just food for thought and consideration.
Just want to make sure everyone knows this is Mr. Bell, Troy Bell, our new city manager, who just came on board 2 weeks ago.
What's the pleasure of the boards? I'll remind you, I can't make a motion. Got your light on there.
And I'll add one other thing too. I agree with you. I have been involved in RFPs and RFPs for many, many years. And when you have respondents that do not meet the requirements, that's one thing. Failing to meet the deadline or failing to provide your response to the right address or right location is a red flag when evaluating.
Yeah, it's not a regularity we typically waive. Yeah.
Mr. Chairman.
Yes, sir.
I move that we accept the sole, we make a recommendation to the boards to accept the sole RFP response.
There's a motion on the floor. Is there a second?
Second.
I have a second. Is there any further discussion? Before I call for a vote, Joe, can we do a roll call considering we have some members in the audience?
Yes.
Or do you want me to go all in favor and see if we're all in favor first?
Go ahead. Jerome.
Okay, all in favor, say aye.
Aye.
All opposed? Motion passes unanimously. All right. Next steps. Ms. Kaiser?
I don't believe we need to do anything with the matrix, given that we only have, and the vote's been taken. That's really the end of the agenda for the luncheon meeting.
Okay.
And we'll start the police meeting in 5 minutes.
Mr. Chairman, I have one question. When will we have to get back to understand the results of what all the pension boards actually voted on concerning the hiring of an administrator?
We do have 2 pension meetings yet today, the police pension and the general pension. The fire pension has already made a meeting, had their meeting, so we would have to schedule a special meeting. Yes.
Can that be scheduled today or is it too late?
Well, you wouldn't meet the noticing requirement.
Yes.
Yeah, so it'd have to be at a later date, but you're saying we could take up that discussion at the meetings this afternoon?
Yes.
But I would almost.
Yeah. Mr. Levinson?
Trustees, so the good news is that there are 2 more board meetings today. So those 2 boards can approve moving forward with the contract, assuming that's what they want to do. And I encourage Scott to stick around for as long as he's able to do that. The other point, though, is on the fire meeting, which was this morning. So it is true that they would have to have another board meeting, which could be a very special purpose meeting where they would just vote to hire the contract if that's what they want to do, to sign, authorize the chair to sign. And the good news is that if the police and if the general employees vote to move forward, we can have the contract turned around pretty quickly, and Scott can begin the transition process, getting records, and he walked you through, I believe, the things that have to go on behind the scenes. So he can start doing that once the contract is signed. So we're not rushing to do it at the last minute. So that gives plenty of time for police and for general, and then for fire. It's not urgent that they meet immediately because we can start the transition for the other 2 boards. But I would welcome setting a fire board meeting, and there doesn't have to be a huge amount on that agenda. And perhaps, and I'm not sure how many of the fire trustees are in the room, they might want to revisit and go into further detail with the actuary on the item which they're studying. So they could do 2 things at that special board meeting. They could vote on the contract if that's what they want, and they could also delve back into the weeds of the pending ordinance issues having to do with the plan design. So that's all I wanted to say.
Only question, Mr. Chairman, is for the police pension board meeting. Is that a part of our agenda today to talk about the RFPs?
So trustees, this is Levinson. It seems to me that would fall under the attorney's report. So even if it isn't listed as a separate standalone item, I have no problem including it under the attorney's report and voting on it, because I think it's all subsumed in the discussion that you had during this lunch meeting. And I think it would be counterproductive to unnecessarily stretch things out when you want to eventually move forward sooner rather than later with the transition.
I just wanted to make sure we didn't get into an advertisement issue.
Thank you for that clarification. So Jill, I think we will leave it to you and the chairman of the fire board to schedule a special called meeting for those 2 items. With that being said, is there a motion to adjourn? Not yet.
Sorry, I'm sorry. With all of this in here, I know the attorney said that we had to vote independently as boards, but could each board vote in here now on this independently? Or does there have to be discussion and question?
Well, that's what we just spoke about. We have 2 board meetings coming up this afternoon. He's saying that we can take it up under the attorney's report. The fire pension will still have to call a special called meeting, but they also have another item they need to deliberate and discuss in more detail. So they've got two reasons to call a special called meeting. Motion to adjourn?
Motion to adjourn.
Thank you, sir.
I like to go ahead and call the firefighter, police pension to order. It's 1:30.
The road. I will give you a ride back in my car. Sure. Gotta go east and I'm not going to west. What's that? She's gonna be heading down to I-4 at Daytona and cutting down I-4 to Claremont. It's up to you. So I'm just giving you an option because given the choice, I will say, but then you're talking about getting home in the evening as opposed to a little later. And I don't like to make that choice for other people.
It's fine. Okay.
Yeah, because, you know, I will stick around for the other two meetings and not worry about what time I get home. And I still have a way to get back to my car. It's only 4 minutes off of 95.
Appreciate you guys showing up.
Thank you. Appreciate it. You know, I'm really excited. I know it's hard to get excited about a pension meeting, but that's
been on our-
what I'm excited
Sam,
about.
it's good to meet you. Sir.
Likewise.
Appreciate
Yes. All right, we are in the meeting now.
I'd like to call the, City of Palatka Police Officers Retirement, trustees meeting forward. Roll call, Ms. Beer.
Um, um, Scott Nast,
Here.
Matt Newcomb,
Here.
Mayor Carrera. Is absent. And James Norwood.
Present. You should have an opportunity to read the minutes. Is there a motion to accept those minutes?
Motion to accept the minutes.
Second.
We moved and second that we accept the minutes of the, City of Palatka Police Officer Retirement Plan from our last meeting. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Capital City Trust, Dwayne.
Mr. Chair, if I could,
Excuse me, yeah, we have, Mr. Latlinson on the line.
trustees, can everybody hear me?
Yes.
I have a question, which is, did Scott Bauer leave or is he still in the room?
He is still here.
Okay, so what I'm going to suggest, and this is entirely up to the board, is if he is sticking around, and I don't know that he wants to stay for the whole meeting, I would have no objection to moving the attorney's report up. That way the board could vote if they wanted on signing the contract and moving ahead with the contract while it's still fresh in your minds. And I also wanted to know, did any more trustees come, or we have the same group that was there for the lunch meeting? Because it's possible that some more police trustees showed up.
No, this is the same ones.
So it is then up to the trustees if you want to continue in the regular flow of the agenda, or if you wanted to make a motion to move up the attorney's report. And as I said at the end of your last lunch meeting, I have no objection under the attorney's report to moving ahead if that's what the board wants to do with the Pension Resource Center contract. And then at your next meeting, we'll ratify that. So you'd vote on it today if you want, and you could ratify it at the next board meeting. And that's entirely up to you. But I do want to make sure any of Scott's questions or any questions you have for him get answered.
If it pleases the board and Adam, Kyle and I are here to stay through the end of the day, essentially. So we don't plan to leave unless it's really not the pleasure of the board that we should be here.
I would think that we would stick with their regular, agenda. Since everybody's going to be here anyway.
Okay.
Okay.
Okay. All right, good afternoon, Dwayne Madron, Capital City Trust Company. Before I get started, I want to introduce Keith Jensen. He's the Palatka president for Capital City Bank. Thank you for being here, Keith. And I'll get started with a little bit of a background on the investment arena. If you page down to the bar chart, which is the first, there we go. So I'll talk a little bit about what happened in calendar year 2023. It was a great year for stocks. And as you can see, a lot of the bars on the left-hand side are growth stocks, information technology, communication services, which includes Google, the NASDAQ, up close to 50%, the S&P 500 about 26%. Small company stocks, R2K, Russell 2000, lagged a little bit because in hard times or slowing economies, small stocks don't perform as well as large companies. And then banks did not do as well because of commercial real estate woes and threats of a slowing economy. Healthcare and utilities, which are defensive stocks, lagged as they normally do when risk appetites are high. So all in all, it was a great year in 2023. The economic growth and earnings growth were better than many people anticipated. Unemployment was low. Consumer spending was good, if not great. And bonds started coming around because interest rates stopped going up and the Federal Reserve signaled that they were in a position to quit raising rates and maybe lower rates. So between October and January, the market went up almost 25%. So the returns for 2023 gained more than you lost in 2022. So we had a bad year in 2022. 2023 was much better, and looks like 2024 is shaping up to be a decent year so far. There's no questions. I'll go on to the next slide. And this is a peek at market valuations. So the top line is the S&P 500 index, and the higher the line is, the more expensive stocks are. But the line below, the blue line, is an equal weighted S&P 500 index. That means each stock in that index has the same weight. The top one is cap weighted or size weighted. Why is it so much more expensive? Because the large companies in the US have done very well, and they are getting expensive. Microsoft, Google, Apple, Tesla, even Netflix. So those companies are, and NVIDIA, those companies are so large, they're able to drive the stock market. 9 of them, well, actually 7, the Magnificent Seven, but so that's what's been going on. Large companies have done so well, especially with the artificial intelligence theme, that they've dragged the stock market up and it's gotten expensive. But if you remove those 7 to 10 stocks out of the index, you'll see that the other companies are much more fairly valued. So what we're hoping to see is a rotation out of the large tech growth stocks into utilities and banks and healthcare, which are fairly cheap. So that we think that rotation is about to happen because the growth that we've seen between October and now is just not sustainable. It's all being pulled up by excitement from artificial intelligence. So I think it'll be a good year, but I'm hoping that the market will be more broad instead of focused. If there's no questions, we can go on to the policy review. So this is the pension plan. The actual position is under the column that says percentage of total market value. You can see large equities at 38.6 are underweight because large stocks are getting expensive. You can also see that small cap is underweight because small companies have a hard time when there's a threat of a recession. And the rest of the asset classes are pretty close to the policy percentage, and they're all within range of the policy operating ranges. By the way, cash is now paying 5.3%, which is almost as much as a bond. So it doesn't hurt to hold cash. So we'd have 5.9% in cash, and if the market pulls back a little bit, I may add some to stocks. There's no questions there. I'll move on to the performance. Page 6. This is the equity side. It's not the bonds. So this is a fiscal year to date number, by the way, from September till now. The pension plan is up 10.6%, outstanding. Stocks are up 11.67, meeting the S&P 500 because small cap stocks and international stocks have done better as the dollar got a little weaker. Taxable bonds are high yield bonds. They tend to follow stocks because they're equity-like in nature. And then you see where cash returned 1.26, but over the last 12 months, cash returned 4.7. And you can see each of the last 3 years, the equity side returned 5.3, which is a lower number because the 2022 number is in that 3-year column. And each of the last 5 years, 11.86. That is a pretty good return. So as far as the fiscal year goes, we're off to a terrific start. And so hopefully that will bring returns up over time. And the next page over, page 7, is just the return snapshot at the end of January, where stocks had a good month in the month of January. But
The bonds fell back a little bit, but still fiscal year to date at the end of January, 10.8%. On track to beat the 7.4% target. And then the next section of the report is the asset allocation, 69% equities at this point. And the market value is 11,178,511. And then you see the index funds, which most of your plan is made up of low fee index funds, with the exception of 2 or 3 money managers and in specialty asset classes where you need active money management. And that's all I have to say. Are there any questions?
No questions? Is there a motion?
Motion to accept the Capital City report as presented.
Second.
We move to second that we accept the Capital City report as presented. Is there any other discussion? All in favor?
Aye.
All opposed? Motion carries.
Thank you.
Burgess?
Thank you, Mr. Chairman. Good afternoon, everyone. I'd like to take you to page 8 in my materials. Just to review the strategic recommendation that I made back in August of last year that was implemented. And I want to just give you a sense of what was done and why. You can see under the table under percent target for domestic equity, 52%. Previously, it was 37%. So we increased the focus on equities domestically. To do that, we raised money from international. 7% we took away from international. We took 3% away from convertibles. We took 2% away from private real estate, and we eliminated the REIT completely. And so, as it turns out, so far, for example, this year, eliminating the REIT was a good idea because the REITs are down about 5%, and the large caps are up about 6.5%. So that was a nice move. And we added a little bit to bonds, up 2%. So up to a new target of 24 from 22. As I mentioned to you last time, bonds are actually pretty exciting right now because the yield to maturity is about 6%. And in the last 20 years, the bonds have averaged about 1% per year. So the rising rates that occurred with Fed policy has allowed the bonds to be repositioned into higher coupon or higher yielding securities. That's very, very good. I'll take you to the summary remarks.
Sorry.
On page 4.
Maybe when our clerk comes back, she can get me back to where we belong, but there we are. Okay, what page were you on now?
Did we just go over page 8?
Yes.
Okay. Any questions on that? Okay. And while we're still there, can you go back to 8? I skipped something. What I mentioned back in August was a concern that we had regarding international. We had a 15% target in international. And, as I said, it was dropped to 8. So it was dropped by 7 percentage points. That's a significant drop. We're concerned about China. China is the second largest economy, but I'm not sure they're going to stay in that position. India is now the 5th largest economy, and China may be at their peak. They have a lot of unemployment, and they have a huge real estate problem. They have major real estate operators have defaulted on their bonds and their bank loans. So they're challenged, and Europe is challenged because of the high cost of energy. So that was the main reason for this shift away from risk into U.S. stocks. And I think so far it's serving you well. All right, so Miss Jill, if you could take us please to page 4.
First, I got one question.
Yes, sir.
And the question is, domestic equities, what makes that up?
Well, so
I think we talked about some of it.
I'm gonna take you right to it. Let's go to page 11. Oh, page 11 illustrates 6 million in domestic equity, and the 75% of that is invested in the Vanguard Institutional Index Fund that Dwayne handles. And that is all of the household names you can think of, whether it be drug companies, manufacturers, insurance companies, banks. Tesla's even in that index, high tech, whatever. Everything it's a big conglomerate of large US companies, and many of them are multinational corporations. John Deere, Caterpillar, they're all in it. So it's a very good representation of the US economy. Now, while we're on page 11, Dwayne commented about small caps. You do have an allocation there. It's relatively small now. It's 680,000. And he's right that smaller companies have more difficulty getting capital than the big companies. In fact, the bigger companies seem to have better balance sheets, and the larger companies are performing very well in this market, outperforming more recently both mid and small cap. Did that answer your question?
Yes, sir.
All right. Back to page 4. The quarter was outstanding. You earned $1 million, 9% net. The program ranked in the top 21st percentile. Meaning that you outperformed most of your peers, 79% of your peers. And I should mention that many of your peers have a higher allocation of private real estate, which is struggling right now because of office exposure. And many of them have exposure, more and more have exposure to private equity, which you have no exposure to, which is having more and more of we'll call it a valuation debate and transparency concerns. So you're not in those kinds of investments. Everything except for American Realty, which is private real estate, is liquid. The best performer for the quarter was small cap, and then followed by mid cap. And I mentioned to you that small and mid is struggling right now because of rates. There was a euphoria in the fourth quarter, which we're talking about, that the Fed likely had ceased its tightening policy and that they would hold rates level and perhaps begin lowering rates during the first quarter that we're in right now. They have not chosen to do so. It appears that their rhetoric is that they're going to keep rates where they are for the time being. That has scared those folks who were concerned about interest rates, and that's what's put pressure to push down the relative performance of small and mid. But for the quarter, those two areas did very well. An example of interest sensitivity is how the smaller and mid-sized companies respond to rates. Rates go up, they tend to fall faster. Rates come down, they tend to rise faster than large caps. The one-year number of 1.4 million earned is also impressive. Patrick doesn't seem that impressed, but it's okay. Result, I know, he's a good man, isn't he? But 12.4%, take that any day. Your bogey is what, 7.4?
I believe 7.5.
7.5, okay. And the top performers were the Vanguard Institutional, is what we talked about a little while ago. That's where you have 3/4 of your domestic equity, followed by international. And you remember I told you that we rolled the money into domestic because away from international. Remember I told you that? You can see the domestic did considerably better than international for the 1-year period. Unfortunately, the 3-year average captures the debacle in 2022 when all of these pension plans were crushed both on the equity side and fixed income side, which is highly unusual, extremely unusual. In fact, I've never really seen it happen like this in my career. But the 5-year is still pretty impressive at 8.4 net, given the fact that that it went through the 2022 period. The 10-year average of $6.8 million or 6.1% net captures a couple of very difficult years. If you go back 2 years ago and show the same 10-year illustration, your 10-year average was pretty close to 8%. So it's amazing what 1 year can do in spoiling the longer term averages. I'm almost finished here. Cohen and Steers infrastructure is a pretty rock solid investment program, and I'll show you back on page let's see, if you go to page 11, they experienced a return for the quarter of 12%. And this is a very conservative portfolio, half of which are utility stocks, utility companies. But utility companies are very sensitive to interest rates. Rates go up, utilities get crushed. Rates go down, utilities rally. And back to that theme of falling interest rates, created that huge 12% return for the Cohen and Steers. The convertible index is where you have exposure to the convertible bond market. I had a great 5-year average compared to bonds, and that was inserted in there some years ago as a bond substitute. It's a bond, but it has an equity optionality component, sort of a turbocharger. If you believe that interest rates are likely not to be favorable, but the equity markets are going to be favorable, the convertibles do very well. Euro-Pacific has been coming back nicely as they rotated away from out of China and moved their Asian positions more towards Japan. And with that, I'll open it up for questions or comments or. Oh, I skipped the private real estate on page 12. We are receiving the income from the private real estate. It's actually coming back to the plan. It's not being reinvested. We don't have a large position here. If we did want to do a full redemption, it would take quite a while to get the money back. We did get out of the REIT, so we've considerably reduced the real estate exposure from 10% down to 5% by way of getting out of the REIT. This product, it has a good balance sheet. Only about 19% is debt, and most of their debt financing is term based over a number of years. There's nothing on the horizon that concerns us about their balance sheet. But for the next couple of years, pressure will continue with the marking down of their private of their commercial real estate holdings, office buildings. By the way, my office lease is coming up in a couple months, and we're downshifting our space by 50%. So a lot of people like me don't need the space because people don't want to work in the office every day. And so that's going to be going on for quite some time. And I guess that concludes my remarks for today.
Any questions for Burgess? The motion.
Thank you.
Motion to accept the Burgess Chambers report as presented.
Second.
And move to second that we accept the Burgess Chamber report. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Foster and Foster.
All right, I've got iPads here, but I think you guys have it in your packet, the valuation report.
Are these a gift, Christmas presents?
Not for you.
Oh, all right.
But I also have 4 paper copies.
Patrick, is this the same report that you went over in
I think they have.
the fire meeting,
Oh, yeah, well, but it's specific.
the specific to us? Okay.
I heard mention of the fire meeting you know, on the agenda for this meeting, I believe, you know, we have a couple different items, but the first one is the valuation report. This is the report that I do every year as of October 1st. And so if you go to page 6 of that report.
Patrick, it's Levinson. Can I jump in real quick?
Sure.
I understand we may have at least one new trustee today, and I'm not sure if that new trustee has been through evaluation before. So I'm just going to point out that trustees, in my opinion, as an attorney, one of the most important reports you review every year is the actuarial evaluation. And whenever we have a new trustee, I know Patrick works hard to make sure he's not using jargon and making it understandable, especially for new folks. And my quick observation is, especially for a new trustee, we view the fiduciary duty as really asking questions and making sure you get answers to questions, which is why I like to say that when you're dealing with an actuary, there is no such thing as a dumb question, only a dumb answer. So with that said, Patrick, again, I don't know if our newest trustees have been through evaluation before, but keep that in mind as you introduce the subjects.
All right, hopefully I won't give any dumb answers, but basically the whole idea of this report, we actually had a question when we had the fire board meeting, and somebody said, you know, I've heard in Illinois and other places where these plans are defunct and what's the issues? But basically in Florida, the state law says that every board has to hire an actuary, which is me, and we have to do a valuation every year. We have to look at the assets in the plan, and then we project out the future retirement benefits, and we determine a minimum funding requirement for the next year. And the difference between Illinois and Florida is that the state law says that the city is legally obligated to make that contribution. So that's what this is on page 6. Looking at the assets and the liabilities, we've determined that the total funding requirement for the current year is 31.6% of payroll, and next year it'll be 30.9% of payroll. So it actually went down slightly, which is obviously a good thing. The members make 6% contributions of their salary. So that leaves the bottom line, city and state, going from 25.6% for this year to 24.9% of payroll for next year. And then they get to offset whatever comes in from the state. So last year, the state monies came in at $99,811, and that represented about 5.5% of payroll. It's not going to be exactly that this year. The state monies might come in a little higher, hopefully, but the payroll might be different. So, it might not represent exactly 5.5% of payroll, but right now that's our expectation. So that means the city right now this year is at about 20% of payroll, and next year it'll go down to about 19.5. So it was a good overall valuation, snapshot that we look at. So I said we look at the assets and the liabilities. So on the asset side, we had a good year, but for this actuarial valuation, where we determine this actuarial funding requirement, we're allowed to use a smoothing, a smoothed value. So that's on page 32. So basically, at the beginning of the year, you guys had $11 million in the plan. And Burgess already mentioned, we have a 7.5% assumption. That's what we're expecting. And so we expected to earn 817,000 on that money. And we actually earned 894,000. So we had a return of 8.27%, which beat our 7.5. So that was a good thing. But the smoothing that I talked about is in the upper left-hand side. So we're going to take that $77,000 gain this year, and we're going to spread it out over 5 years so that the city's costs don't go way up or way down. But you can see there 2022, we had a net loss of 3.2 million. And we're recognizing 1/5 of that each year for 5 years. So that 2022 loss was much more significant than our 2023 gain. So using that smoothing, we had a loss of 481,000 this year, mostly by recognizing some of that 2022 loss. Now, the good news is we're off to a good start, and maybe we'll have more gains to work in this year. But does anybody have any questions about that 5-year smoothing? And we basically started it over 10/1/20. We said going forward, we're going to start a new smoothing. So that's why you only see 2021, 2022, and 2023 on there. After a while, you'll have 5 years in this smoothing.
So it's not, so we're not using the 1 year would drop off and another year comes on for the 5-year smooth. Are you just?
Well, it's similar to that, because in 5 years, we're no longer going to be recognizing, well, in 3 years, we're no longer be recognizing that 2021.
Right.
So that will drop off, and it'll be replaced with whatever gain we get in, say, 2025. So it will still be kind of that same method.
It's rotating.
Exactly,
Okay.
exactly. It's just a slightly different method, but very similar to that old one. So then but still one more second on that page, because it deals with something we're going to talk about later. But, that 2022, that huge loss that we had, if we would have not been smoothing, the city's costs would have went way up that year, and then it would start to come down as we get gains. But we'd rather have it spread out. So I just wanted to point that out.
In fact, Patrick, before we went to the smoothing, it used to be the city would have those huge ups and downs and whatnot.
Right,
I think
right,
that
right.
we went to the smoothing back in, was it 2007? Okay. So
yeah, I mean, it reduces the volatility for the
Okay.
city.
So the city has not experienced those ups and downs. It's been more of a, it helps
smooth
them
ride.
easier. It makes it much easier for them to plan their budget.
Exactly correct.
Okay.
So page 39 then is the turnover. And you guys do keep having turnover here. At the beginning of the year, you had 21 non-drop police officers. Remember, drop people are like retired. So we had 21, 5 people terminated and took refunds of contributions. And then you hired actually 10 new police officers. So you went from 21 to 26, which is a good thing, as far as, we'll talk about that in a minute, but the higher payroll actually helps the percentages a little bit. So that was the top of the page. The bottom of the page, sadly, as an actuary, it helps when people pass away, and you had nobody pass away this year.
Is how many of the new police officers that they hired, how many of them actually enrolled in the pension fund?
All of them. It's
All of them
it's
have-
a requirement.
Okay. Okay.
Correct. Yeah, in order to get that 185 state monies, it has to be required for all participants. Mhm. So then I'll take you all the way back to page 18.
Hey, Patrick, this is Levinson. Just a quick clarification. Can you hear me?
Yep.
Just to further put more context on the last question, all of the sworn police officers have to be in the plan. But if you're not a police officer, if you're working in the department as a community service aide, or if you're working in a secretarial non-sworn position, then you're not in the police plan. But Patrick is absolutely correct that all police officers with badges and blue uniforms, at least that's the color I think it is these days, that they should be and are members of the plan.
But those non-sworn officers has the opportunity to get involved in the general fund, right?
Yes, sir.
So we've talked about assets and liabilities already today. And so the difference between those is what we call the unfunded actuarial accrued liability. So last year it was 1,682,000. And we're making a payment each year. That's part of the city's funding requirements. So we expected it to go to 1,465,000, and in the end it was 2,198,000. And so the biggest reason for that increase in the unfunded liability was that smoothing technique with the assets. So that was a loss of 481,000. Then the second line is salary increases. So individual salary increases were larger than normally expected. I think you guys did some contract changes or what have you. So the average was slightly higher than our expectation. And so if everybody's salaries are a little bit higher, well, their projected benefits at retirement then are a little higher than we expected last year. So that's a little bit of an actuarial loss, 100,000 in this case. Turnover was pretty neutral. Inactive mortality, like I said, was a little bit of a loss. You had some rehires. And then, so all in all, an increase of 732,000. Then the previous page 17 is basically how we're going to pay that down, that $2.2 million liability. Well, we're going to make a payment each year to pay that down to get it to zero. So right now the payment is 276,000. So you can see that almost the last line there, that $732,000 increase this year, we're going to pay $77,000 a year for 15 years to pay that down. And so our total payment there is 276. But then if you go to page 13, this is where that increase in the number of employees helps. So your payroll went up also this year, right? You hired the new police officers. So your payroll actually grew at the same rate as the unfunded actuarial accrued liability payment. So those three are how we get the total funding requirement. The normal cost is just every police officer earning one more year of benefit. So that stays stable, 13%, 12.7% this year. That's an annual cost of everybody accruing benefits. And then the administrative expenses, that's our fees and Jill's fees and all that. Well, when your payroll goes up, you know, then that's a smaller percentage. So that went from 2.8% of payroll to 2.5%. And then the third line is that payment required to amortize the unfunded, that mortgage payment. Well, that went up as a dollar amount, but so did your payroll. So it actually represents about the same percentage, 15.8% last year, 15.7% this year. So that's why your total funding requirement went down slightly from 31.6% of payroll to 30.9% of payroll. So the firefighters today asked me, you know, what happens, does it help if we hire new firefighters? And it did help you guys this year that you hired new police officers. People talk about the funded ratio. You know, I talked about the accrued liability and the assets and that unfunded liability. Well, from a percentage perspective, that's on page 11. And towards the bottom, it says it went from 88.4% last year to 85.4% this year, because the liabilities increased with salaries and the assets didn't grow as much using the smoothing technique. So Adam wanted me to go over it, you know, fairly well, and hopefully I did, because I know we have more actuarial topics today, but I'd be happy to answer any more questions about the annual evaluation report.
The evaluation from the pension fund is healthy.
Correct. I mean, your goal is to be in that 80 to 100% funded ratio, and you're at 85.4%, so you're in that healthy range.
Patrick, it's Levinson. Can everybody hear me?
Yes.
I want to bring us to page 6 of the summary and building on the question that was just asked, which was how does our funded ratio compare? So here the question is, how does the city contribution compare? And I will tell everybody that one of the plans that we have that's in litigation has a employer contribution of 100%. And your contribution, meaning the city on page 6, is basically 20% of pay. So I'm wondering if you can put some context for that 20%. And I want to say that the FRS, and I'm ballparking, is around 33%. So just if you could answer the question, how does the city contribution to fund this plan compare with other foster and foster police or fire plans?
Sure. You know, every year or most years in the summer, we come do a list of all of our plans, and both the funded ratio is on there and the city contribution rate. So I'm pulling that up now. But, you know, based on the 2022 valuation, last year's, the median funded ratio was 88.2%. And you guys, I think, were at 88% last year. So you were right at the average of all of our plans in the state as far as the funded ratio. And then city contribution rate, that the median was 23.8% of payroll last year, and you guys were at 20.1, and this year you're going down to 19.4. So your city contribution rate is on the lower half of our plans in Florida, meaning that the average city pays more than you do for the contribution requirement. Does that answer the question, Adam?
It does, which demonstrates that the plan is running a tight ship, and the trustees and the staff, et cetera, are to be commended, because you don't want to have a high employer contribution. They're usually either investment losses or negative experience. So the actuary and the finance department can smile when the city contribution is heading in the right direction and is on the lower end. So that answers the question. Thank you.
Motion to accept the valuation report as presented.
Second.
Valuation report. They were in discussion.
Aye.
All opposed. 185, Patrick, right?
Right. Minus color. So we were we were earlier on page 6 of the valuation report. Remember, we had a total required contribution, and then the members contribute 6%. And then we had a city and state requirement. And then we had another line after that, and it was state contributions. And so what that is that 0.85% of everybody's basically car insurance premiums, that gets collected by the state, and then they send it back to the plan to help provide additional benefits for the police officers in Palatka. And so there's been a long history of how to use those state monies. And Palatka was kind of ahead of the curve in a sense. And as long as I've been here, 26 and a quarter years, the city ordinance has provided a methodology. And it basically says that the police officers get the same benefits as the general employees, which is a 2.5% benefit rate. And then they get an extra benefit that's paid for with accumulated state monies, those premium taxes. And right now that multiplier is 0.55%. So, right now the total benefit for the police officers is 3.05% times their average final compensation times their years of service. Well, not every city uses that same method. Adam mentioned, this chart that I have with all of our plans. Well, you guys are the only, Palatka Police and Fire are the only of those, 200 plans that uses that exact methodology. So it's something that can be changed if we want to. And part of the reason that you may want to change it is the fact that retirees' benefits can change. So, you guys are maybe going to hire Scott Bauer here in Pension Resource Centers, and they're going to be in charge of mainly interacting with the membership, right? The retirees, and making sure their benefits are paid and all that. So if we do this valuation and their benefit goes down, they're going to wish they weren't hired, because those police officers are going to call and say, what the heck? I was getting, $2,000 a month, and now it's $1,900 a month. So, most plans don't have a benefit for the retirees that can change. So that's something we talked about at a previous meeting, and you said to come back with, ideas of things we could do differently. And so the first idea on this page is on page 2. Or actually, page 2 kind of shows the calculations, and we talked about this at the last meeting. But page 3, I guess, is where the real alternatives start. But one of which is to use smoothing when we're calculating this multiplier for the retirees and the active members. We do that already in the valuation. You said we started it in 2007. So we've never started it for this calculation, where we look at the assets and how much the state monies can pay for. So that would be one possible change that we could do. And so if you look on the top of page 3, with the market value method, no smoothing, the multiplier was 0.6, and then it went to 0.65, and then it went down to 0.55. So it went up and then down, because the market went up and then the market went down. And so with the smoothing, it actually would have remained at 0.6 all of those years if we had been using the smoothing method to do this calculation. Now, the caveat there is that 2022 loss that we talked about, that's going to be in the smoothing the next 3 years. So it's possible that 0.60 that we'd have right now could go down each of the next 3 years. So the smoothing, you're still going to have ups and downs. It's just going to be more gradual. Does anybody have any questions or about that? So the second method would be to keep the same methodology. We're going to look at the state monies and see what it can buy going forward. But we'll fix the retirees' benefits. So now if we have an investment loss or a gain, right? Right now it's shared between the actives and the retirees. So if we have a loss and everybody's goes down, the retirees go down and the actives, right? If we freeze the retirees and we have that loss, now we've got to spread that out over only the actives. So you're going to have more volatility. And so on the second or the page 4 at the top, it shows what would happen under that scenario. So the members would have, the retirees would have stayed at the 0.6 in that middle column. They would have just stayed there because your benefits would be frozen when you retire. But now the benefits for the active employees, they're more sensitive to that investment. So it would have went from 0.6 to 0.9 to 0.4 to 0.45 if we had said, okay, we're going to take those market losses or gains and spread them out only for the active employees. So that you know, that's probably better than what we have now, because then the retirees can count on their monthly benefit when they retire. It's just that it's going to depend on when they retire. So, you know, if you retired in this scenario in April of 23, well, you're going to get a good multiplier. You're going to have that 3.4 multiplier. If you retired a year later, April of 24, then you're going to have that 0.4. So you're going to have a 2.9 multiplier. So it's going to be dependent on when you retire, what your benefits are going to be.
Question on that. Would that be retroactive? We have to go back to when somebody retired 10 years ago.
I don't think you would make this retroactive. You know, we could do the smoothing retroactive maybe, but this is an ordinance change, and I don't think you would make this retroactive. Well, no, they would stay at whatever their current benefit is. We would. Exactly. But we wouldn't go back and say, well, what was it the year they retired? We wouldn't change it to that. We would use whatever it is right now. That would be their benefit going forward. Well, because well, up until now, the ordinance has said we have to look at the state monies each year and the retirees are adjusted. So right now, based on the money that we have right now, that's their benefit. Remember, it was fluctuated on purpose. But we could freeze it now and say, going forward, we're not going to fluctuate their benefit. But otherwise, there would be a loss. I mean, if we're going to give the retirees, let's say they retired with the 0.65, and we're going to say, now we're going to bring you back up to the 0.65. We could do that. There's nothing illegal about it, but it will cause an increase in the city's funding, because right now, the requirements I showed you on the valuation is based on a 3.05 multiplier.
I just think one figure of
Yeah, we could do that, you know. It's not gonna make a huge difference because a lot of the retirees retired under the 0.6, and now it's at 0.55. So bringing you up to the 0.6 isn't gonna have a huge impact. But you're right, we could do it that way. It would be negotiated, you know, all of this.
With everybody else getting what they get retirement, we're getting this selected. I can see everyone getting a lot.
Maybe we shouldn't have had this discussion before you guys signed the dotted line there, but
Yeah, but I think, doesn't this change for everyone every time that there is a change, whether it's high or low?
right now it does.
Right.
Right now it does.
Yeah, but if we were to freeze, everyone that's retired right now is making the same rate, whether it's someone that retired 20 years ago or someone that retired 5 years ago.
That's what we're doing right now, yeah.
But if they retired and their rate was better, they should be getting the better rate because our new ordinance will say you get the rate at retirement.
Yeah, I see what you're saying. Yeah.
The ordinances frequently say as of date. They'll say, and as, you know, as of this date, this is the change that's going to happen. So you don't have to go back and refigure everything. Because, yeah, there will be some with lower rates.
Yeah.
Yeah, my vision was that they'd stay at the current, but I understand your question. And as far as legally, Adam's got his hand up, so I'll let him talk.
So trustees, I'm not sure how many of the police that are here were sitting in on the fire meeting. So I'm not sure if they're aware that the fire board decided to table it because they want to study it further. And I'm pointing out to you that there's a lot to think about. And I appreciate that Patrick put the time into writing this detailed summary. So it's important we understand all the moving pieces. And unfortunately, I have a new moving piece to add into the conversation. And the Florida legislature is a variable. And there is a bill this year, and we're probably going to prepare a memo. And I think the League of Cities may also have a memo at some point. And I'm going to tell you about Senate Bill 7074 and also House Bill, I think it's 7073. And, you know, it's hard to predict the future, and we don't know if this will be adopted. But we think a lot of our pension friends will be opposing this bill, which would effectively lower the amount of premium taxes. So let me take a step back for a second. So the system that we've had in place for many years has worked very well as long as the premium taxes were going up over time. And what we saw about a year or so ago, the premium taxes fluctuated, and that's what brought this to your attention. And that's why the trustees asked you to do this study. And that's why we're looking at this. So there was a fall off with regard to premium taxes about a year ago. So that's why we're talking about it. But if Senate Bill 7074 gets adopted or House Bill 7073 gets adopted, we expect that the premium taxes will be lowered by the legislature. So that's why this is a good time to have this conversation and for us to get into the weeds of what this means. And it's hard for attorneys. We don't want to give our opinions. And attorneys want to make sure we're telling you, the law allows you to do this and the law allows you to do that. So we give you parameters, but we shouldn't really tell you what you should do. But in that context, retirees don't like it when the benefits go down. And, and it's the job of the attorneys to make sure you're following the law, and you have followed the law because you've had your ordinance, and your ordinance is totally legally acceptable. But the new, and again, we don't know if this change will be adopted, but there is a proposal that would effectively, and it's diverting some of the premium taxes for other purposes. So there would be less money from Tallahassee to fund the benefit, which ultimately, if it goes through, would lead to a lowering of this exact issue, this adjustable rate. So that's why this is a good time to have the conversation.
So then maybe that's a good segue into, well, alternative 3 is just a mix of the two. We would use the smoothing and freeze the retirees. So then you can see that the actives doesn't have as much of a sway when you do the smoothing. It's more smooth. There's not as much sharp up and sharp down. So that would be alternative 3. But alternative 4 is what most of our plans have in Florida. And for them, the multiplier is fixed. It's in the ordinance. Like right now, it says 2.5 plus something else. The ordinance would say the multiplier is 3.05% or 3.15% or whatever the multiplier is. And that would never change unless you guys negotiate with the city and decide to change the benefits. And so most places have a fixed benefit for retirees and actives. And then with the regards to those state monies, they basically draw some kind of a line in the sand. Like you guys would probably draw the line at whatever you got this year, the 79 or the 99,000. You know, you would say, okay, the 99,000 is paying for these benefits that we have. And now any increases we can share with the city. So either share 50-50, 100-0, whatever, you can share it with the city. And then those monies then go into a pot for the police officers. And it's almost like a defined contribution. That grows with whatever earnings happen. And then when they retire, they get a lump sum, kind of like the drop in a way. And so that would actually be good from, I mean, I hate to say, if Adam's right, you know, I guess that's why we don't like attorneys, because they give us bad news. But let's say the state monies go down next year. Well, then, you know, it doesn't affect the benefit. You just wouldn't get an allocation to your share balance, but your balance you had previously would stay in there and grow. You just wouldn't get a contribution that year. And then if 2 years later, the legislature kicks it back up, then you would get an allocation that year, each police officer. And then that would grow. So it would help, you know, we wouldn't have to worry so much about the volatility in state monies if we had a share plan.
But this would never have an effect on city's contribution.
Right, ideally, it has no effect on the, ideally. Well, the only argument that the city could say is if we're getting $100,000 in state monies and our payroll is $1 million, that's 10% of payroll, you know, that $100,000 in state monies 10 years from now might only be 5% of payroll. So it may not be providing the full benefit that it was 10 years ago. So to answer that, most plans share those increases. So if the state money goes up $10,000, the city gets to go up 5 and the members get 5. So that way the increases in state money keep up with the increases in payroll, so the city wouldn't have that argument. Does that make sense?
Makes sense.
This would have to be negotiated because the ordinance is clear right now, you know, of the benefits, and you don't have a share plan, but that doesn't mean it couldn't be negotiated.
But Patrick, if the officers were to go with a shared plan, I'm trying to wrap my mind around it, because as you're talking, I'm reading it and I'm listening to you talk. So if the officers were to elect, go through this board and elect, and then they make a motion, and then go before the commission, actually, I guess we'll go before the city manager for negotiation, and then to the commission, for approval. There wouldn't be a cost associated, an additional cost associated to the city if the officers were to negotiate a higher multiplier.
If the multiplier is not 3.05, then there would be an impact. There would be a cost. And like you said, let's say we give all the retirees whatever they retired with before, then some people might get a little bit of a raise, right? So the share plan has no effect because right now the city is getting 100 or 99,000, right? And assuming you you decided to share future monies above 99,000, then it wouldn't affect the city's costs at all. If you said instead, we're gonna keep our 3.05 multiplier and we're gonna only let the city use 50,000 each year and everything else goes into the share plan. Well, then now I would do an impact statement and say, okay, city, instead of 19.4% of payroll, based on that 5.5% from the state, it would go to 21.4% because the members are taking some of that state. So my vision is you'd negotiate that future increases in state monies would go into the share plan. And that would have no impact on the city's funding, to answer his question. They'd be using that money they have now, the 99,000 a year, to pay for that benefits we have right now, the 3.05 multiplier. So negotiating a share plan that uses future increases does not impact the city. Well, if there was a decrease in 185s, like Adam said, it's going to hurt them either way, right? Right now they get 99,000. If next year we get 89,000, well, then they have to make up the difference. So.
That's also hopefully the offset.
Right.
But, if it passes, small.
Right, the state would be smaller and the city has to make that up. And in our case, the retirees have to eat some of it, because of whatever the state money is. But we're looking mostly at the accumulation of state monies with interest. So if it's a little less next year, it's not going to affect our calculation very much. Long term, it will. If every year it's smaller, then that accumulated state monies in our calculation is smaller, and that would cause me to say, okay, now the multiplier has to be reduced a little bit. So, but if you negotiated where the benefits would be frozen at the 3.05 or whatever, then any increases or decreases in state monies would hurt the share plan and it would hurt the city's bottom line funding, but it would not change the benefits, the defined benefits of the members.
Patrick, what would happen in any of these plans, and I guess maybe it would be different in every one of them, I don't know, if the officers were to contribute more? Meaning, I think right now we contribute, or the officers contribute, well, I guess we, because I'm one of them, we contribute 6%. If they were to contribute 7-8%, does that just mean that they're contributing more to the fund and then their portion is growing, or would that also require the city to contribute more because they're contributing more? Or does that have any impact at all on any of this that we're talking about?
Well, like for let's say the multiplier, if we don't do the share plan, well, even if we do the share plan, generally, either the members negotiate to increase their contribution to help offset the city costs. So if you were at a city, Adam mentioned we're in a legal battle or whatever with some city that has 100% of payroll, right? So they might, through union negotiations, say, okay, we're willing to bump up our contribution by 2% to help the fact that you have a high contribution rate. So it could be just that. But usually, if we're increasing the member contribution rate, it's because the members want an increased retirement benefit. So if it's 3.05 now, some places will say, members will say, I want to increase my contribution so I can get a 3.15 multiplier when I retire. So generally, increases in member contributions are associated with the a new benefit of some sort, an increased multiplier or a 20 and out or something that the members want to pay for. Generally, that's how it works with member contributions. So it doesn't really affect any of this in a sense. Except that, you know, if we freeze the benefits at 3.05 and go to a share plan, if the members would really rather have the 3.15, you know, then they can negotiate with the city and say, okay, we'll put in an extra 2%, make your 6% up to 8%, and we'll get a 3.15 instead of 3.05. And the city will say, okay, if that's the cost of this increased benefit and it doesn't hurt the city, they're fine. You know, that's how sometimes it works.
So out of, and I think I might be jumping the gun a little bit with this question, but out of all these plans that you're presenting to us today, under this shared plan on page 5, it says share, letter A, it says the most common method used in the state. Is this the one that you would recommend that we were to go with?
Well, when I say most common method used in the state, that's plans that do have a share plan. Once you decide you're going to have a share plan, then you have to decide how to share it among the members, right? So we get this $5,000, $10,000 into the share plan. Now you have to share that with each member. And so the most common in the state is you get 25 shares if you've been here for 25 years. If you've been here 2 years, you get 2 shares. And I mean, I would, again, like Adam said, it's up to the membership, but that would probably be my recommendation, because this whole purpose of this pension plan is to reward long service, right? That's why you have this 185 pension plan. And so keeping with that same philosophy, then you would say, oh, let's share the state monies in that same fashion. So, but you could do equal. Everybody could get an equal share. It doesn't have to be that way.
But in the shared plans, the top one on page 5 is the most common.
Yeah, I would say 90% of my plans that do have a share plan base it on their total credited service. That would be the other 10%. I mean, we do have a couple of 13th check plans, but that's on one hand.
So in your experience with making changes to plans like this, if you were to make a recommendation from an educational perspective for us, what would you recommend? Because the way I'm looking at this as the assistant chief is I'm going to have to go back, and Lieutenant Mast is going to have to go back, and we're going to have independent conversations with some of our staff. And I don't have the training and experience or knowledge that you have on this. So when I go back and I try to talk to our officers, especially those that are within the union about this, I really need advice on what to give them guidance on. So is there a specific one of these that through your training and education and experience would be more valuable to them? I know you're giving us a bunch of options.
Right. Well, the state monies have almost always gone up, as Adam mentioned. So the issue with the retirees and the investment has always gone up, you know, for the most part. So the issue with the fluctuating benefits for retirees hasn't been an issue the 26 years I've been here until recently, you know? And so, but I do see it as an issue that could happen more and more. So if you want my my opinion is you should try to negotiate to do something, any of these, starting with alternative 2, anything that freezes the retirees, I think would be beneficial. And the even alternative 2 for the active employees, where it can still fluctuate quite a bit. I'd almost, if I was a membership, I would rather alternative 4, some sort of a share plan, because that way, if the state monies go up, you can get some more money in your share plan. If they go down, you get nothing in your share plan, but you don't have to worry about that multiplier, that benefit that you've worked hard for and you were promised. I mean, if you hire somebody today, as the assistant chief, you hire somebody, you're telling them you're going to get a 3.05 multiplier. You work here 25 years, you're going to get 25 times 3.05. Well, under the current structure, you're going to have to say that with a grain of salt, because it could change. And if they go anywhere else, they're going to be guaranteed that benefit. So I think even from the city's perspective, if you want to recruit and retain, it would be better to be like all the other cities and have a fixed monthly retirement benefit for the actives and the retirees. So that's what alternative 4 does best, but right now, the city shares any big investment losses or anything with the members. So from the city's perspective, they might be like, oh, I like the way we have it now, but I just, from a member's perspective, I like alternative 4. And I think if the city looks around at all the other plans and sees that's what everybody else does, hopefully they're okay with alternative 4. They share in increases in state monies too.
Thank you.
But like Adam said, I am not to give you guys advice on benefits. I'm the actuary that values the benefits. So there's an ordinance and it says, here's the benefits. And I have to do that valuation each year. And when people retire, I have to do that calculation and I have to use whatever's in the plan. As far as negotiating what's in the plan, that's not something I should do.
Yeah, no, I understand that. I was just asking from your experience, what do you see? Basically, what do you see others doing?
Yeah, that I can answer. Alternative 4 is far more common than any of the other ones.
Thank you.
Trustees, it's Levinson. Can you hear me?
Yes. we
So
can hear you.
again, it's not my job to tell you what you should do, but we like to give advantages and disadvantages and to give context. So the first bit of context is right now you're an outlier and it's worked well over the years because you've been able to raise it. But there's the possibility that it may actually have to start coming down as it did last year. So the question is, do you want to join the majority of other plans that fix the monthly benefit? And there are good reasons to fix a monthly benefit, because that way a retiree, they have a certain standard of living. And if the benefit goes down and fluctuates in the downward direction, that causes hardship potentially for retirees. So there are certainly advantages of fixing it. That certainty is an advantage, and it deals with expectations. So those are advantages. Another consideration is keeping it simple. Right, that's the KISS principle. You don't want to have things necessarily super complicated. So, Patrick, I'm wondering if you can walk through, advantages and disadvantages, and ultimately, the actuary can be a resource. Our office can be a resource for trustees and for the union and for HR, et cetera, so that you can understand these options. And I also encourage any of the trustees, if you want to speak to Keith Brinkman up in Tallahassee, he won't charge you. You can speak to him for free. And he'll tell you, that this bill potentially would, if it gets adopted, would have a big financial impact, especially in year 2 and year 3 down the road. So we're dealing with a lot of uncertainty, but unlike some of the other professionals who have an hourly fee, and again, we're always happy to talk to you, feel free. And his name is Keith Brinkman. He's the head of the local retirement section. And he can tell you what he likes and doesn't like about the bill. And he can also share with you, what other cities are doing. And unfortunately, this is something where, the situation may be changing a little bit depending upon what gets adopted in Tallahassee. And the final observation, so you've got certainty, taking off variability is a good thing. The other option and the other idea is keeping it simple. And I think Patrick talked about that. The third thing I threw out to you is speak to the folks in Tallahassee and make sure you understand it. And make sure the members understand it, because you're always going to have people, this is what lawyers worry about, people who aren't happy and they always blame the grass is always greener. But if people understand it and you do a good job of making sure there's transparency, then you can't be blamed because you can't predict the future. And you've done your job, which is putting options on the table, helping everybody understand those options. And the actuary in our office can play a constructive role in that process. And also feel free to reach out to other cities. Right. Feel free to speak to unions in other cities and speak to police, chiefs and HR departments in other cities, see what they like, what they don't like. And if you go to some of the conferences, don't talk to each other about this, because this is a board level sunshine, but you can talk, the police trustees can speak to the fire trustees, you can speak to someone who's not a trustee, obviously, and you can speak to other cities. So the bad news is at some point a decision has to be made, but the good choice is, or the good news is that you have options, you have resources, and we want to help.
But also, we could also use the Florida League of Cities, because when this bill is implemented, they're going to do some research and come up with some recommendations on how to handle it anyway.
Yes, sir.
Well, we don't have to.
So really, I mean, the board can't even necessarily make any decisions on this other than this first one about smoothing. We can do that, but the rest is more educational, like Adam said. You guys talk to the members and you administer the pension plan. So I don't think the board has to do anything today, but this was informational.
Yeah, but I think there's a lot of resources out there that we could actually use in order to help us bring us to the right decision.
Ms. Jill, did the fire department board, did they discuss having a presentation of any kind done before the fire services concerning this?
No, they didn't. Not at all.
Yeah, but I mean, I'd be happy if through the process, if the membership or anybody wants to get together and go over these options, Adam and I, we'd be happy to come and make a presentation,
Adam, can you hear me? So the reason I asked that question is the police department has just recently unionized the officers that are eligible to be in the union. And as such, we are in kind of uncharted waters for us, because I've been with the city for going on 29 years and we've never, well, we were union for about 6 months and then we vacated. So knowing that this is a negotiation kind of thing with the commission, with the city, our board only has so much power in this. I'm wondering if it wouldn't be best for my staff for us to plan a meeting opportunity. Because to be totally honest with you, I personally am not comfortable with trying to meet with staff and discuss something that I don't have the knowledge base that the two of you guys have.
Yeah, definitely.
I welcome that question, and workshops are a wonderful thing. Sometimes cities hold workshops, the city commissions. Sometimes it's a joint workshop between the city commission and a board. Sometimes it's a membership workshop where the union gets invited, HR gets invited, and you talk about options. And I'm all about the education, and I respect that these are complex issues, and none of us have the right answers, but we can bring you information. And I think this is something where homework, and that's how I'll answer the question. Homework is important, and you want to make sure sure that you're thorough because people can always, not be happy because they can second guess. But if you put the information in front of people and you help guide them and you engage in a conversation, and the actuary can do that very well, and our office can also participate. And I'm wondering, is Bauer in the room?
Yes, sir.
Okay, so I don't want to put him on the spot, but he happens to work with a good number of plans. And I think he'll tell you there are advantages of keeping things simple because he administers share plans. And Scott administers, all the different flavors in Florida. So I don't want to put him on the spot, but I'm curious if he has any thoughts on, whatever wisdom he wants to share or doesn't want to share, making the point that it's a conversation.
What I don't like about the share option is that it represents a 0.5% increment and multiplier. It's about a 1/6 increment that shifts the defined benefit to a defined contribution type benefit for the retiring members. And so it assumes that everybody will manage that well. But the reality is that for some, they will end up with a additional amount at retirement that won't last, and they'll have a smaller benefit thereafter. So you also have a drop plan that turns about 25% of your benefit. Potentially, if somebody were to do a career and drop for 5 years, that turns about a 25% of your benefit also into a lump sum in combination with a monthly benefit. So taking that share or chapter 185 money and turning it into a share plan is turning a much greater proportionate share of your overall monthly benefit at retirement into a defined contribution alternative, a little bit more than makes me comfortable. That's my feedback, but only because we interact with a lot of those retirees and understand that their means and circumstances are limited, but a lot of time they do better over a longer period of time with a greater monthly benefit than they do with something that gets spent and doesn't last. That's being a little bit paternalistic too. I get that, but you asked for my opinion, and that's my very
Trustees, can I react a little bit,
version.
Scott, to flesh it out? And I'll do this in a minute. I won't go more than a minute.
Yes, certainly.
So what Scott is pointing out, and I agree with his issue. That's a good issue to raise. If you only have a share plan and you're not locking people in at a higher multiplier, in other words, if you're putting all your eggs or many of your eggs in the share plan basket, the reality is a lot of retirees, when they leave, they're going to have a big share plan. They're not going to have a very high monthly benefit. And a lot of people burn through the money quickly because they're not good at, phasing it in and living off of it, which is an issue which has to do with the way retirees, and I'm not blaming anybody. This is just human nature. People tend not to be good investors because often they buy high and they sell low. And they spend more than they think they need. So what it boils down to is there are advantages in locking in a livable monthly benefit. And I think that's one of the points Scott's making, is that from a retiree, and I'm referring to retirement perspective, from a retirement security perspective, there are definitely advantages to locking in a benefit. And sure, the share plans are good, but you don't necessarily want to put too much into your share plan basket. And I'm hoping that makes sense for everybody.
Yes, and that was the point. Thank you.
So how would going to a shared plan, what would that do for people that are currently retired? Or would that do anything for them at all?
Normally the share plan is only for active employees.
Active employees. Okay.
This thing requires, but one of the things that I would all the active employees, and since it's not going to say retirees.
Well, and you may, if we're going to do that, maybe we can at least coordinate with the firefighters. It doesn't necessarily have to be the same meeting, because I know you guys have different issues. But maybe if we're gonna, Adam and I are gonna come here on, June 10th, let's try to do it. We'll meet with the police officers in the morning and the firefighters in the afternoon or something like that. Like you said, to save on expenses, that would be a good thing.
Yes, sir.
But I would also suggest that advertise. Get like the conditions. They're gonna hold
Make that decision.
on.
I'll work on that with Assistant Chief Branford and with Jill to put something together on that. And with you guys.
Awesome.
We do have a one remaining issue with the valuation report, and that's the rate of return.
Oh, yeah, the state every year tells you to do that declaration of your expected return for the next year, the next several years, and the long term thereafter. It's a separate motion. And Burgess was okay with 7.4 for the fire, so I'm sure he's okay with 7.5 for you guys. So if you could just make that motion, that's a separate motion. Exactly. No, this is different.
Okay.
I motion that we keep the rate of return set at 7.5%.
Second.
Second, that, the whole section, plan.
7.5.
Is there any discussion?
Aye.
That's actually, we're joint on that, but had you made a decision on the share plan today, then that would have changed the mutual consent document. But if we agree to continue sharing the money from the state in the same way as you currently share it, it can be changed later on in the year, but I need a document now saying that we have a mutual consent right now that says it's going to be shared just like it has in the past. And if you vote that, then I'll get you the paperwork to sign. Keep that.
Well, and that's what the firefighters did this morning. I mean, it's in place now. It can be changed. We're talking about changing it, but right now that's the situation.
I motion that we sign the mutual consent document, keep things as they are right now, at least until a change can be decided in May.
Second.
Is there any more discussion?
Aye.
Adam, it's your turn.
Have my mic on, Adam.
Sorry. So the good news, trustees, is we have a short attorney's report, and I want to welcome any new faces that I can't see on the screen. So I'm filling in for Anna today, and the short attorney's report is really two things. The first is to summarize the change in the law dealing with Form 1s and how Form 1s work. And some of you may already be very familiar with this, so wave at me and say, move ahead, Adam. But what the memo talks about, and does everybody have a copy of that memo, or everybody know what I'm talking about? It's a one-page memo from our office. Everybody have that? So I'm wondering, and it has our palm tree logo on it. So if you see the palm tree logo, then you're looking at the right document. So what we're doing here is we're letting you know that everybody already knows that, however long you've been in the position of being on a board, you've always had to do your Form 1. So for you, your Form 1's not going to change, but the way you file it is going to change. So in the past, there are, I think, 63 or 62 counties in Florida. So every member from the different county would file it with the supervisor of elections in your county. And you do this every year. And the year you leave, you do what's called the Form 1F. So now what's happening is you're going to be filing your Form 1s instead of with the county. It's going to be centralized up in Tallahassee with the Commission on Ethics. So there's a new website, and everybody will file their forms on the new website, and you have to start doing that in June. And we want to make sure you do it by June 30th, and we'll remind you at the next board meeting. So are there any questions about the website that you're now going to have to use to file it up in Tallahassee instead of at the county level? Any questions so far?
No, sir.
So thank you. So the next part of the conversation is, some of you may have heard on the radio or in the news, depending upon local media, that some people are not happy about the new change because for certain elected officials, there are additional requirements that deal with their personal assets. So these new, more detailed reporting requirements don't apply to police and fire or general employee trustees, but they do apply to elected officials and mayors and city commissioners. And there are examples of mayors saying that this ain't worth it. I'm not going to run for office. I'm going to resign because it's nobody's business, you know, what art I have on my wall and how valuable my jewelry collection is, because it gets more into the weeds of personal property. So I'm just pointing out to you that those other requirements don't apply to you. What does apply to you is that you have to file it in Tallahassee. And we'll talk about this more at the next meeting, and we're available to answer any questions. And then Scott, I'm going to point out to everybody, some cities, the clerk's office will do this. And in some cities, it's probably going to have to be the pension administrator. So in order for the website to work, the different entities, so the different agencies, so each of the pension boards is a different agency, a different entity, has to appoint a coordinator. And the coordinator's job, and it's fairly simple, is to let Tallahassee know who the trustees are. So that way Tallahassee can find people if you don't fill out your Form 1s. So every board, every city commission has to have a coordinator who really plays a ministerial function, letting Tallahassee know through the website who the trustees are or who the elected officials are. And some cities, the clerk's office is doing it for everybody. And in other cities, they want the pension administrator to do it for the respective pension boards. So that's just something to look forward to. And you can't, as a trustee, input your Form 1 unless somebody, either from the city or the pension office, is serving in that role as the coordinator for the website with Tallahassee. And let me pause to answer any questions because I threw out a lot of information.
Currently, it's our city clerk because we have so many boards. She's the coordinator.
So I'm thanking Sunny for what she does, and she does a great job. It's just different cities do it differently. So unless there are any other questions, the second topic for the attorney's report, if we want to vote on it, and I'm comfortable, so let the minutes make clear, I am comfortable that this is really the continuation of the lunch meeting. And if the board wants to vote on pension administration, you absolutely can do that. And the motion would be to authorize the chair to sign the contract that I'll prepare. And Scott and I have done so many of these. And again, we've worked with all the administrators. So it'll be the standard contract based upon the quoted fee. So if you want to vote on it, you can. And then at your next board meeting, we'll put on there to ratify that vote. That way we're covering all our bases. But I'm comfortable if you want to vote on it today. And as I think everybody understood, there are reasons why you don't want to rush to do a transition. So that gives plenty of opportunity, especially for 3 boards if they're all moving together within the same year. So I have no objection if the board wanted to move forward. And I want to thank Scott for staying here to answer any further questions. And I think that you will be well served if the board does decide to use the Pension Resource Center.
You're not leaving till October.
Correct.
And if we authorize the pension attorney to execute the contract, when would the contract begin?
Well, it would have to, the next meeting would be to ratify it.
Right.
So it would be effectively in June.
It just won't, I guess, and the reason I'm asking that particular question is because I want to make sure there's adequate time for us to, I guess, for the current pensioners to make the adjustment to someone not being available when they walk in and want to talk about their pensions and that kind of thing. But we know eventually it's going to come to that, but we need to make sure that they're prepared for that so that we don't, as trustees, get accused of just changing everything. And they can, they no longer can have that opportunity, to do that.
Ms. Jill, do you have a list of retirees that are currently on, I mean, I know you do.
Yeah.
Is there a way for me to get a copy of who it is and what they're showing their current address is? Because what we can do between Chief Shaw and I is we can send a letter out letting them know that the board is moving forward with having an independent administrator and who that administrator would be effective October 1 or effective whenever our contract would be official.
Yeah, I can get you that information.
But also in that letter too should be, that the need, if the need arises, they should schedule appointments with the administrator.
Correct.
So that they can meet with them, discuss whatever concerns they may have. Okay. Is there a motion then to move forward with executing a contract for the resource center to become our main administrator?
I make a motion that we authorize our attorney to move forward with drafting the contract to hire the resource center to run our administrative program of our retirement program.
A second.
Been moved and second that we ask this pension attorney to execute a contract with resource center in order to administer the police pension.
Yes, sir.
Is there any discussion? All in favor?
Aye.
All opposed? Motion carries.
Trustees, that concludes the
anything
attorney's
else?
report. That concludes the attorney's report unless there are any other questions.
Thank you, sir. Quarterly expenditures.
The example of the quarterly expenditures is in your packet. It's also up here on the screen. You had one retiree or one resignation and taking out their money, their contributions. Retiree payments are pretty normal, October, November, December. If you look on closely, you'll see the liability insurance, the postage and supplies, and the pension administrator. That's what you are currently being charged this year for pension administration. That makes up, when Patrick was showing you the 2.5 or 2.9% of the pension, that's those expenses, as well as the attorney's fees, as well as the actuary's fees.
Is there a motion to pay these expenditures?
Motion that we accept the quarterly report as presented.
Thank you. Motion, I was about to die without a second.
Second.
It's been moved to second.
Sorry.
That we that we accept the expenditure report. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Public comments? No public comments. Is there a motion? Is there any other business? Any meeting dates?
Yes, reminder that the next meeting date is June 4th. And it will be earlier. It will not be at the 1:30 because of conflict with this room. So it's going to be at noon.
Anything else? Any other business coming before this pension board? If not, is there a motion to adjourn?
Motion to adjourn.
We can adjourn.
Thanks, everybody.
Thank you.
Yeah. That might be.
That's a good thing.
It is.
Thank Hope it's not after 5 o'clock. You're talking about the ad hoc. Valuation report. Yeah, gotcha. Yeah, I mean, the other meetings have both Dwayne and Burgess. No, but you have to talk about the COLA study he did. No, don't. You can push it to another meeting. Because you do only have an hour. Unless you can talk to Burgess to make sure his report is short. That's our job, and we can read. My wife, and said, look, if you want to take the finish to me, come with me, and then you're here all day. Hey, how are you? Oh, I gotta get all the new reports. Hold on.
Thursday's talking about his younger days. Younger days. Don't talk about Georgia. North Carolina. Not really the most part of it. I got out there and got it, doesn't that mean like, yeah, pretty wide pedal. You have a barn? No, yeah, I got, it's not really a barn, it's one of those kids you buy, they drop off, you know, little thing. Your kids, I drive that. Your kids go up there and stay? All the time. That's it, that's for all. Grandkids, they love it. That's just a nice place. I thought I was gonna get shot. We got a place on that 3 hours. Oh, wow. Yeah. But it's over. That's quite a big noise up there. Thank you. This is all 5 attachments or however many there were.
They're all there.
I got my emails. I gotta get my new printer set up. I get my emails now. I saw all these things that came in.
Great.
But I haven't had a chance to look at them yet. My dad, he died, he mowed his lawn for this time. He had a neighbor.
Yeah.
Have any complaints? Okay, Jill?
Been a long day, but it's downhill now, right?
You guys should read the journal. Sometimes I would go past my house and I wouldn't stop. No. Well, Iowa is, I'm going home and going to Cleveland.
know, I know. It's.
That's why I got so.
How far is the path home?
My house is not that bad.
My wife wouldn't say.
No.
She doesn't like that.
Doesn't like trying to be called.
You know, it doesn't bother me when I leave today that there are a few calls that I can return to certain people. That I do like. It's quiet, I know, it's a little.
Yeah, I mean, it's nice in the car when you've got nothing to worry about. It can be relaxing.
It makes Florida here really small, it's not as big as they are. I didn't, I said Bill.
You want me to go to his office? I
He's
don't.
not,
have-
he's not in his office. Let's get started.
All right.
Voted nothing.
Yeah.
Who's his office?
My old office.
Oh, yeah.
I sit right there during the day if you need to find me,
Yeah.
so.
No, he's coming down to PGA. Look with,
All right,
encouragement at that.
well, let's get this show on the road, folks. I think some of us got places to be. All right, so we'll call the General Employees Retirement Plan Pension Board meeting to order. Roll call,
Brett Dennis,
Here.
Jonathan Griffith,
present.
Troy Bell. Is absent, maybe he'll show up, and, Mr. Bush.
Yeah.
Alan.
All right, we have a quorum.
We have quorum.
Thank you. So board members, in your packet, we have the meeting minutes from the November 28th meeting. Has everybody had a chance to review the minutes? If so, is there a motion to approve?
I'll make a motion to approve the minutes.
There's a motion on the floor. Is there a second? Any further discussion? Seeing none, all in favor say aye. Aye. Opposed? All right, moving on. Item number 3, Patrick?
All right, my evaluation report should be in your packet. So if you want to go to page 6. everybody's kind of sick of the actuary today, so I'll be pretty short. Because I also have to admit, if you look at that page, you know, every year we look at the assets and the liabilities and we determine an appropriate funding requirement for the next year. And the cost went down slightly. So the total required contribution for the current year is 36.8% of payroll. The members contribute 6%. So the city is at about 30.8% of payroll. And for next year, it'll go down to 29% of payroll. It went down by 1.8% of payroll. And the main reason for that, you actually had unfavorable experience. You had a smoothed investment loss and you had larger than expected salary increases. So all of that would say, oh, your costs should go up, but your payroll went up quite a bit. You had salary increases and you hired some additional employees. So now our mortgage payments, some of those fixed costs are now a smaller percentage of payroll. That's the main reason why the costs went down on page 6. But on the investment side, that's on page 30. So we have an assumption of 7.4%. That's what we're expecting to earn every year on our investments. And we actually were very similar. We earned 7.45% this fiscal year. Burgess is going to give you a good report because he's looking at calendar year. So remember the last 3 months of the year were really strong, as was the beginning of the year, but the September quarter was a bad quarter. So anyway, we pretty much met our assumption, but we're using a 5-year smoothing technique now. So in 2021, we had a great year. 2022, we had a horrible year. And we're recognizing some of that 2022 loss. So at the bottom of the page, on an actuarial basis, using that smoothing, we had a 2.95% return. And so that was an actuarial loss there of $935,000. So that's what I said. Most of my plans have a little increase in their funding this year, but yours was offset by that increase in payroll. Does everybody understand that 5-year smoothing there? So then turnover is on page 37. So this page wasn't a big deal this year. You didn't have big gains or losses on turnover because we expect a certain number of people to leave and we expect, sadly, a certain number of people to pass away. So if you look at that page, the main thing, I guess, is at the top, you had 87 non-drop general employees. You had 20 people leave, you know, before retirement. You had 1 retirement, 2 drop members, and you hired 28 new employees. So you went from 87 to 92. So that's what I was saying about your payroll went up, and that actually helped you. At the bottom of the page, you had, sadly, you had 4 of your retirees pass away, but 2 of them had survivor benefits. You know, either a joint annuitant or a 10-year certain beneficiary. And you had 1 of your beneficiaries pass away. So all told on that page, you know, it was really kind of similar to what we would expect. Not a big gain or loss on that page. So then if you go back to page 17, you know, I said we look at your assets and your liabilities, and the difference between those as of October 1, 2022 was $6,619,000. But we're making a payment each year to pay that down. You know, that's part of the city's funding requirements, that 30% of payroll on page 6. So we expected it to go to $5,779,000, and it actually was $7,192,000. So we had a net actuarial loss there of 1,413,000, but 935,000 was that smoothed investment return that we talked about earlier. And then this year, average salary increases were higher than we expected. I think there was negotiations and some salary increases. So everybody's projected benefit then is higher than we expected the year before. So that increases the liabilities. So that was an actuarial loss there of 417,000. So really, it was just those first two items, the investment smooth and the salary increases. So then if you go to page 16, 15 and 16, but page 16 shows you, that loss we had this year, that $1.4 million, we're going to pay $148,000 a year for 15 years to pay that down. So, your costs would have went up back, remember, on page 6, but that $1,067,000, now go to page 13. Or 12, I'm sorry, page 12. So this is the funding requirements. The top line is the normal costs, and that's just every general employee earning one more year of benefits. So that stays pretty stable, went from 11.6 to 11.9% of payroll. And then the administrative expenses, that's Jill's fees, our fees, the attorney's fees. Well, if your payroll goes up, now it's a smaller percentage of payroll. So it went from 1.1 to 1.0. And then your payment required to amortize the unfunded, that mortgage payment, that went actually from 24.1% of payroll last year to 22.1% of payroll this year because your payroll was higher. So I know you have people that need to leave at a certain time. So those were kind of the highlights of the report, but I'd be happy to answer any questions anyone has.
Any other board members have any questions? Brett?
I guess this is good news. I mean, it goes to 29% of payroll for next budgeted year. Is that correct?
Correct.
Okay. And so even though payroll went up and the smoothing hit us, it's because there's more payroll that we have less of a percentage that we have to pay. Is that?
Exactly. I mean, as a dollar amount,
Yes.
the cost might be a little higher,
Yes.
right?
Right.
But our contribution requirements are determined as a percentage of payroll. So
And so far,
they're going to put that 29%
Mhm.
in for all the employees. So since payroll went up, that's giving you a larger dollar amount.
and this is the number we can use for budgeting for next year, 29%.
Correct. That's fixed.
Right.
Percentage is fixed for the dollar amount that we have to contribute for budgeting purposes. How much?
29% of the payroll next year. So when you're doing your budget, if you want it as a dollar amount, the first step is to say, what do we expect our general employee payroll to be next year? And that's how you could get the dollar amount. Correct. So if the board's happy, then it needs to formally approve the report, and that'll make it official for the city.
Just to be clear, the contribution we've had to do in the past has been much higher, 33%. It seemed like that number's been much higher in the past, right?
I believe so. I have last year's report here also. So the year before that, it was 33.6.
Yeah.
And then it went to 30.8, and now it's 29.
So this really is good news.
As far as a percentage of payroll, yes. I mean, like I said, you did have an actuarial loss,
right?
But now you can spread it over a larger payroll.
Right,
So.
22 was a rough year.
Right, and we're spreading that out over 5 years, so you might still have losses the next 3 years, but we're off to a good start this fiscal year. Maybe we'll wash out some of that 2022.
If there are no further questions, we'll entertain a motion to accept the valuation report.
Make a motion to accept it.
There's a motion on the floor. Is there a second?
Second.
Any further discussion? Seeing none, all in favor say aye. Aye. All opposed? Motion passes.
Patrick, do you want to do the declaration of returns?
Yeah, every year the state tells us the board has to make a declaration of their expected investment return for the next year, the next several years, and the long term thereafter. And it's kind of silly because, we already do that in the valuation report, but they want you to do this extra declaration, and I'm comfortable with 7.4%. Let's see what Burgess says.
I'm comfortable with, I expect 7.4% next year over the next several years and over the long term. And Jill will prepare a letter to that effect.
So the board has to make another motion to basically so moved.
So just for the sake of understanding, what would be some logic in either decreasing or increasing that expected return?
Well,
Well,
you
it
just
can-
said that the costs stayed, that they went down a little bit, right? Well, it's all based on how we do compared to how we expected we would do, right? That's what makes it go up or down each year. So you want that assumption to be as accurate as possible. So if we think we're really gonna earn 9.4 every year, then what would happen is that we'd keep beating it and the costs would go down, down, down. It wouldn't be stable. But if in other words, if we think we're gonna earn 5.4 and we always get 5.4 and our assumption is 7.4, well, then every year it's gonna go up. So we want our assumption as good as possible. But if you were to raise it, then your costs would go down right now. Because we would say, okay, we expect we're gonna earn more on our investments. We can put less money in right now and vice versa.
What
So
did we state last year?
what did you say?
What did we state last year as our
We
projected
kept it
Same.
the same at 7.4.
Yeah. I mean, you've been at, you were 8% for a long time and there was a steady, but 0.6% decrease in 10 years is a nominal decrease. And it falls within the expected return based on the modeling that we do. So I'm comfortable with 7.4.
The state actually asked us to lower it a little bit, didn't they?
The state is putting pressure on everybody to come down towards into the mid sixes. Yeah.
Right, they've sent letters, but the letters that most boards get and the letter that you got said, hey, we'd prefer you guys lower that assumption. There's only been a few where the state has said, no, you must lower your assumption. So this year, really quick, this year I got 3 letters and they were all at people that had 7.75%. So if you had 7.75, you might get a letter from the state rejecting. But you're at a comfortable, you're okay with 7.4.
Mr. Bell, I believe you had a question.
Yes, so the assumption last year was projected 7.4, right, and what was realized?
Just about the same. We got like 7.45 was our actual return. So you guys did perfect on your assumption last year. That's never going to happen again, but you did perfect last year.
You never know.
Is there any reason why we wouldn't go ahead and lower it? I mean, what would the impact be on the percentage of contributions in?
Well, usually about a 0.1 reduction. So if you went from 7.4 to 7.3 would be about 1% of payroll increase for the city's contribution. So the 29 would go back to 30 if you wanted to lower it by 1/10. But and really quick, so Burgess and I are on the same page here that in the past, the state was saying you need to lower it. Everybody was lowering it. And that was because we couldn't get anything out of our fixed income, right? If you're going to get 10% in stocks and 1% in your fixed income, it's going to be hard to get that 7.5 or 7.4. But now we're getting like 5% on our fixed income. So if we get 10% in stocks and 5% on fixed income, and we've got 65% in stocks, we're going to make that 7.5. So I'm not as concerned about lowering that assumption at this moment.
Well, what's the pleasure of the board?
We accept the report.
Well, the declaration now is what we expect on our investment return, and we're proposing.
So 7.4.
Yeah.
Is there a motion on the floor to that effect? There's a motion on the floor to keep the expected return at 7.4%.
Second that motion.
Thank you, Brett. Any further discussion? Seeing none, all in favor say aye. Aye. All opposed? Motion passes. Thank you.
Trustees,
Burgess?
could I give a minute of just more context? 30 seconds? So Tallahassee wants you to have this conversation every year, and the minutes reflect that you just had the conversation. And in future years, you'll continue having this conversation based upon the direction of interest rates. And if you have a really good year, if this return continues for the balance of the year, it'll be less expensive next year to lower it. But over time, Tallahassee wants to see you do it to lower. And the context is that the FRS has lowered a lot. So over time, you may continue to lower. There's no urgency to do it this year, no urgency to do it next year. So it's a conversation. And every year, the actuary and the consultant, Burgess, will bring it up and you'll revisit it. So there's nothing forcing you to take any action. In fact, most of my boards are doing the status quo, which is exactly what you did.
Thank you, Mr. Levinson. Burgess?
Good afternoon. There's another item for me, Burgess.
Sorry, maybe I did that intentionally.
Thank
All
you.
right, item 3B.
Go quick, will you? Go quick. But this is, I think you guys have this in their packet too, right? So, here you go. So, but, you guys last time talked about the fact that the retirees are on a fixed income and there's been inflation. And you said, what would happen if we gave them a one-time increase? So that's what this study is. It just basically says that if we gave everybody a one-time 5% increase, then that 29% would be 31.1% of payroll for the city. And if we gave everybody a 1% per year retired with a cap of 10, so if somebody's been retired 15 years, they would get a 10% increase. If somebody's been retired 2 years, they would get a 2% increase. So that scenario would be a little more expensive because most of your retirees have been retired more than 5 years. And that would increase the cost from 29% to 32.4% of payroll. And then you guys had the good idea to say, well, how would these really affect the members? And so that the last 2 pages shows you each current retiree. We decided not to put their names in there, but it just shows when they retired and their current benefit, and then what their benefit would be under each of those 2 scenarios. So how was that, Burgess? That was pretty fast. Perfect.
So Jill, this may be for you or Mr. Levinson. Is there anything in the creation documents for the pension that speaks to a COLA or the term defined benefit?
So let me take the first stab, and I welcome Jill's input. So what is the job of a trustee? And the answer is the job of a trustee is to administer the plan. That's the central job of the trustees. Now, if you want, you can always make recommendations to the people who can amend the plan, because you do not have the ability to amend the plan. Your job is to administer it and to take into account, recommendations and the community and everybody else, but your job is to administer, and you can always make recommendations. So in the environment the last couple of years with a lot of inflation, the same question you're asking has come up with other cities, which is what can we do? And the answer is you can do studies, you can put proposals on the table for the elected officials, and the elected officials have to decide priorities. If the elected officials want to help retirees, they can, but you can't do that alone. So really, it's a conversation, whether or not the board wants to make a recommendation to the city, whether or not the city has money in its budget to help retirees. And, it's also a political conversation because retirees can go knocking on the doors of elected officials, and retirees can explain the fact that it has not been easy the last couple of years to be a retiree. And I'll also point out to you that, there was no right answer because different people are going to have different opinions, and there are different priorities and different budgets, and different cities do things differently. And there are some cities that have never put in place a COLA and would never consider a COLA because these are retirees. You get what you get. There are other cities that do what they can because people live in the city, because these are communities, and they want to make sure that people have a standard of living based upon their career of service. So there's no right answer, and that's why lawyers can't tell you what to do.
How does everybody feel about it?
So there's no question concerning the gift of public funds. Looks like he's frozen. No, he's not. All right. Is there any question concerning this regarding the gift of public funds?
Excellent question. So the Florida statutes, this is chapter 112, says you can't increase the regular benefit for retirees, but when it comes to COLA benefits, you can. So you are allowed to have a COLA adjustment. And you would be in good company if the city has the money and can afford to do it. And remember what the process has to be. The board can't make a change. At best, we can make a recommendation. And if the city commission wanted to do it, then we would amend the ordinance. We would draft it. They would have to vote on it. And I'm assuming that it's 5 commissioners. So you would need 3 commissioners to vote to do an enhancement. And they may welcome your input here. They may want the board to make recommendations on what they can do. And some cities will come up with a dollar amount that we can spend X. Other cities aren't going to give a dollar amount. They're going to say, what is the pension board suggesting to us? And they may, it may be going back and forth. But the legal answer is you are absolutely allowed, and lots of cities do it, to increase COLA benefits for retirees.
Okay. Is that, in your experience, typically a one-time, or is it consistently a COLA benefit going forward?
So excellent question. There are multiple ways of doing COLAs, and what the actuary will tell you, if you think it's going to be a one-time, but if there's a pattern of increasing it consistently, then it gets more expensive because then the actuary has to fund it, and let Patrick talk about this, as a more expensive regular benefit. And if it's a one-time, then he can fund it a little bit differently. But these are the reasons why you don't get paid and why you get to make the tough choices. And again, there's no right answer. Retirees are going to want you to do something, and I would agree with them that's absolutely. If I were a retiree, I'd want you to do something too. But at best, you can just make a recommendation, and you can have city staff, if they have further questions, consult with the actuary, and the board can make our actuary available, which we've already done with the study he's done. But you can also be available by phone calls and other consultations, especially if there's new city management who may have other questions.
Thank you.
Well, and the board, the city has 4 times in the past, I'm looking at the city code, and they increased benefits 1 time in 1986, in 1980, or 1993, 1999, and 2003. And they haven't done anything since, well, October 1, 2004, sorry, 2004 is the last time that they've done a change. So to Adam's point, I don't have to put this in the valuation that, oh, you guys are going to do it every year. It's not something the city does every year, but they do it periodically, based on this.
It's not done every year, but the percentage continues forward, right? If they went up 5%, it's gonna be 5%.
Right, if their benefit was 1,000 and now it goes to 1,050, it stays at 1,050.
That's right, okay. So it's not just a one-time.
Right. It doesn't increase every year.
Right,
It just,
right.
right.
One-time increase.
Right, exactly, yeah.
Mr. Bush, you have any thoughts?
No, I had asked for this a while back and you came out with a report.
You all see what's happening out there in the market. Everybody's amount is shrinking, it's retired, with their fix. So I'd like to see as much as we can do, but not overboard.
So if there was a COLA increase, then that would increase the city's contribution.
Right, you're gonna increase the retirees' benefits, so that liability goes up. And then it has to be made up with contributions and earnings. So that's what this calculation did. It said, how can we maintain those higher benefits? The city would have to increase their contribution right now.
From 29 back to 33.
If we did the 1% per year retired, the city would be at 32.4. And that's similar to what we said it was 2 years ago.
Yeah.
Are you talking COLA now?
Yep.
Well, no, I'm talking about the COLA. If we did the one-time increase equal to 1% per year retired, then the city's cost would be at 32.4 for next year.
And this board can't make a decision anyway. We can only recommend.
Yep. So I can tell you how I felt about it. So thank you for the information about when we've done it previously. I've always understood our retirement plan as exactly what it says it is, a defined benefit plan. So when I've thought about this, I've kind of been a little bit unwilling to consider a COLA because I thought the onus was on the employee to consider other retirement investments to kind of diversify and safeguard yourself against these inflationary pressures that we're seeing now. But it really is only an additional, depending on which one you take into account, $100,000 or $170,000 annually, correct?
Correct.
How does everybody else feel about it?
I'm sorry, I missed that.
How do you feel about it?
I think that I wouldn't go into an automatic COLA that raises at a certain percentage each year, take it back to this board each year like we've done in the past, there's a precedent there, and continue that.
Yeah, he's not suggesting that.
Whether or not we give an increase.
Well, I guess the options are we recommend not doing a COLA.
Right.
Or we recommend to the commission to consider a COLA and which one?
Or we make no recommendation at all.
Which is option number one.
I just know I've seen too many cities that put a COLA in effect and they regret it after a few years. I don't know. I'm kind of on the other side of the fence now.
You're on the side of getting the benefit.
Yeah, you're on here somewhere, aren't you? Were you trying to figure out which one you were?
Yeah.
I would like to see us make a recommendation to offer the 5% COLA. I think that a lot of retirees are suffering. Yes, they should know that it was a fixed payment, but they paid with dollars that are more valuable than the dollars we're paying back with right now. And over the last 5 years, I've looked at it and there's been an accumulative effect of inflation, 23%, just in those 5 years alone. I personally would like to see that. And I throw that out there as somebody who hopes that someone will do that for me when I'm in that position. But I'd like to see that happen.
You say the 5%?
The 5%, the option number one.
That's for drop numbers, right?
Yeah, they would be included because they're treated as retirees in this plan.
Versus number 2, which would be a 1% increase.
Well, number 2 is just that everybody would get a different increase depending on how long they've been retired. So if you've been retired for 2 years, you haven't had that full 23% yet. So you would just get a 2% increase. If you've been retired a long time, you would get a 10% increase. So it's 1% per year retired up to a maximum of 10%. So not everybody would get 5%. In the first scenario, everybody gets a 5%.
And what would be the increase in the city's contribution that you estimate going from 29 if we did the 5% COLA?
The 5% one-time increase, that still stays with them, but it's a one-time increase. The new city contribution requirement for next year, instead of the 29.0% of payroll, it would be 31.1%. And so based on your current payroll, that was estimated to be about $100,000.
Our percentage of payroll last year?
So for the current year, it's 30.8, and last year it was 33.6.
So if we kept it at 30.8, it would be something less than 5%.
Yeah, if you did a 4% increase, let's say, then it would be, roughly that same contribution you had this year.
So you want to stick with 5 or?
No, I think you're making a good point that we remain at what our contribution is now, and they get a slightly lower COLA, but we've satisfied, we've helped the retirees out, and we've stayed at the status quo. I think it's a good plan. I know it's not part of your study that you did, but.
Well, and let me just do the math really quick, because it is linear if you're doing an ad hoc COLA like that.
Sure.
So I can calculate it. Yeah, it would be about 1.7%. So you'd be at 30.7% of payroll, and this year you're at 30.8. If you did a one-time 4% increase for all of your retirees.
It's a workable plan. Yeah, I like it.
So related to this, because we keep talking in percentages. So when you do your valuation report, do you take into account expected pay increases for that employee?
Well, the whole evaluation, when I project everybody's benefits, has an assumed salary component. We assume you're going to get salary increases each year. We have that assumption when we project all your benefits. But then when we come up with a total funding requirement this year as a dollar amount, we divide it by the current payroll to get the percentage. So does that make sense?
It does. So I believe there was some discussion about an alternative scenario that would leave us at 30.7% of payroll. If so, is there a motion?
I'll make a motion that we offer the 4% increase, the COLA, on a one-time.
To recommend to the commission.
So sorry, yes, recommend to the commission that we'd like that. Yeah.
Okay, there's a motion. Is there a second?
Second.
There's a second. Any further discussion? Seeing none, all in favor, say aye.
Aye.
All opposed? Motion passes.
Trustees,
Now
it's
you're up,
Levinson,
Burgess.
if you can hear me.
Oh,
No,
sorry,
we paid for
Mr.
it.
Levinson's got something. Go ahead.
Yeah,
Good
so just to
afternoon,
point out,
everyone. Let's go to page
Hold
13.
on. I think
I'm
Adam
sorry,
wants to talk.
Burgess, if I could just make a quick observation. It might be useful for city staff if the actuary can, do a cover letter, and this is a suggestion, summarizing what the board's recommendation, so that it's easier for city staff and the commissioners to understand the recommendation. And that's just a suggestion.
Yeah, I can do that, especially since the letter doesn't have the 4% on there. So I'll do a letter that says with 4%, one-time increase, and I can even do your stat of 23% or whatever, and then say that the cost to the city would be
X dollars.
I got my numbers from Department of Labor and Statistics. You can find
Right.
it online. So, yeah.
Can we take the approach to say that, can we take the approach to say that if the city maintained 30.8% contribution, then that would allow us to do a 4% COLA increase? Okay. I know it's tomato, but.
Details.
Okay. Ready?
Yes, sir.
All right, this is my third comment back here, so here we go. Thank you, and I'd like to take you to page 13 and revisit what we did when we made these changes to the investment policy. The big picture is that you look on page 13, we increased the domestic equity allocation from 37% to 52%. So that's a 15% increase. And we reduced the exposure to international by 7%, convertible bonds by 3%, private real estate by 2%, and we increased fixed income by 2%. So what we're doing here is de-risking away from, I would say, the asymmetry that's evolving globally with trade with China and what's happening in Europe, shifting money back into the US. And that was the purpose of it. And the timing has actually been very good. And if you look at the horizontal bars there, the blue and yellow bars, you can see that at the end of December, as a result of this great stock market rally, we were overweighted in equities, 57.9 versus 52. And February 14th, we moved 1.2 million out of domestic equity and dropped it down into fixed income. So now the fixed income, which you see was underweighted, the blue versus the yellow, we've now pushed that blue line across. It's now at 24%, and we've brought the equity back to 52. So there's a nice example of rebalancing. And the beauty of this is that, as Patrick suggested, we are now getting roughly a 6% yield to maturity on the bonds. We haven't gotten those kind of returns in bonds in over 20 years. Look at the 10-year average return for the bonds. It's been around 1%. It's been dismal. And that's one of the reasons why the state was pushing these plans to bring their expected returns down, was because the bond market. And I think Patrick did summarize that well a few minutes ago. So that's something we did. I think it's useful, and we're trying to be proactive. If you go to page 16, these numbers are a little dated, but that's okay. You can see that we have a significant amount of money now in the S&P 500 index. It's permitted in the new policy. So what we have in the large cap space, we have a $3 million core position. We have now roughly $3 million in large cap value. I'm giving you some updated numbers. Roughly 3 million in large cap growth. So we have across the large cap spectrum, value, core, and large and growth, it's an even balance. And then within the mid cap space, we have a mid cap allocation of 1.3 million through the Fidelity Index. Within below that, where you see Cohen & Steers Global Infrastructure, that's essentially a proxy for mid cap value. And the iShares convertible bond blend is also a proxy for mid cap growth. So we have a nice balance now in the large cap, mid cap, and then we have it rounds out with a small cap allocation of 1.3 million. If you go to the next page, page 17, I'll go to the summary in just a minute. we've seen a nice rebound with international and American, Europe Pacific. They're rotating out of China, moving more money into, the Japanese theater. The soft spot we have right now, regrettably, is private real estate with American. It's roughly represents about 5% of the program. All of the income that's being generated from those properties is coming back to the bank, and we're using it here. We are not reinvesting back into more units. Why? With roughly 19% of their portfolio in office and the projected difficulties in that space over the next probably the next 3 years, we're just gonna have to ride that out. Now, as the rest of the portfolio grows, the equities and the fixed income, the private real estate will become a smaller and smaller portion of the overall mix. We still have some money allocated to high yield, which is actually done well relative to the core total bond fund. And you can see historically the high yield has added significant percentage value. Okay. Talked about rebalancing. We've talked about how things look. Let's go to page, let's go to the summary. I'll wrap it up for you so you guys can get home. On page 5. You had a very good quarter. My goodness. You earned $1.8 million. 9.3% net, almost right over top of the strategic model, and you're ranked in the top 14th percentile. Now that's very impressive. And I should point out that there are a lot of pension plans around the country that are, in my view, they've been overly engineered. They have way too much going on in private equity. They have commodities. They're doing all kinds of wild stuff. You're not doing that. Every 95% of this pension plan is liquid, and we know what we have. We know what it's worth. And I can tell you, there are a lot of plans out there that don't know what they've got. They're not really sure what they're going to do. Elizabeth Warren, bless her heart, is trying to get tighter scrutiny in this whole scheme, with trying to get more regulations of private equity. Huge pushback is going on right now. The SEC is trying to get pushed forward with some improvements in transparency, especially with the way they're compensated. And the lobbyists, they're all lawyers, by the way, Adam, are doing a wonderful job representing their clients and trying to prevent any change in terms of regulating private equities. The 5-year, so for the 1-year return of 11.9%, very good return, a little bit behind the model, but that has to do with some of the balancings that took place in Europe Pacific's 1-year returns, and Voya, but relative performance. The 5-year average was 7%, 6.4 million was earned, and that's pretty close to the 7.4% target. A lot of rebalancing was done in October to get us in line with the new IPS, investment policy statement, and I just gave you an update on what happened in a few weeks ago. So that's about it. Are there any questions?
I don't believe so.
1.8 million, 1 quarter.
Pretty good, huh?
Yeah, that's good.
Sounds like a betting parlor. Someone asked me earlier, what do I think is going to happen? Where are the dark clouds on the horizon? You know, there's $1.5 to $2 trillion in commercial loans that are coming due. It's already happening, but during the next 2 to 3 years, there's going to be a lot of stress in the commercial mortgage market. You're going to see defaults, you're going to see bankruptcies, you're going to see other institutions pouncing on these revalued properties, whether it be in San Francisco, or the Reichman family, a very famous family, real estate family, is jumping all over the San Francisco properties that have gone down 40-50%. So we'll come through it. We've been through these cycles before. The final note on American Core, their balance sheet's solid. They only have about 18-19% debt. A lot of it's term debt. And so if you look at the term sheet, if you go out the next 3, 4, 5 years, there's nothing on the horizon that I'm concerned about in terms of their ability to sustain the trust. And that's it.
Well, if there are no other questions, do we need to accept the report?
I'll make a motion to accept the report as given.
There's a motion and second on the floor. Any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Motion passes. Mr. Levison, I believe you're up.
Good afternoon, trustees. 2 real quick items. The first item is a memo in your packet, which probably has our office logo on it, which is the palm tree, and it deals with Form 1s. And trustees who've been on the board for a while, every year you file your Form 1, and then the way you've done it in the past is you filed it with the supervisor of elections in the county where you reside. And Florida has, I think, 63 counties, 62 counties, so this was decentralized. And what the legislature decided this year, which is new, is from now on, you're going to file it with up in Tallahassee, with the Commission on Ethics. So all of the forms will be available for people to review online, and it'll be easier for people to see them. So I'm just reinforcing it's important to take it seriously and make sure if you have any questions, we're happy to answer any of the questions. And we'll remind you about this at the next meeting because it's due in June, and we'll make sure you don't fall between the cracks. So that's part of the update. The other part of the update is that for certain elected officials, the forms are a little bit different, and they have to provide more transparency on their assets. And there's a little bit of controversy because some elected officials and mayors are saying, I don't want to, this is nobody's business and I'm resigning. But that does not relate to the regular pension trustees. The additional requirements are for certain elected officials, et cetera. So are there any questions about the Form 1? And we're always available behind the scenes to take calls. As long as there are no questions on the changed methodology for filing the Form 1, the only other item is the issue, and I'm not sure if he's still in the room because I can't see, but everybody who's aware of the lunch meeting we had where we spent a lot of time walking through the capabilities of the Pension Resource Center and why it's a very important function. And you don't want to have to do this more than you need to. You want a long-standing relationship with someone that's going to be a fiduciary. So to let you know, at the police meeting, they decided to authorize the contracts to be finalized, and then they're going to vote on that and ratify it at their next board meeting. And the firefighters this morning, their meeting was before the lunch, so they're going to do a special board meeting. And what I'm telling you is if you want to vote on it today, I encourage you to do that. I encourage you to ask any other questions that you might have. And if you vote on it today, we'll proceed with the contract, and then you'll vote to ratify the contract at your next meeting. And it's always good to have plenty of time for the transition, so that way there are no surprises and everything runs smoothly. So that will conclude the attorney's report unless you have any questions.
So, Mr. Bush, I know you weren't here, but what Mr. Levinson said is accurate. We had a joint meeting, and the vote was to, in essence, refer it to the different pension boards for a decision on hiring an administrator, and they're here. So with that said, unless you have any questions or those of us that were in attendance have any additional questions, I'd entertain a motion. So there's a motion on the floor.
Motion to hire.
Motion to hire a third-party administrator. Yes, sir.
Yes.
Just any administrator, or I'm just trying to make sure I'm clear.
Well, we only had one response. Yeah.
I'll second the motion.
Okay. Good clarification, sir. All right, there's a motion second on the floor. Any further discussion? All in favor say aye. Aye. All opposed? Motion passes. All right, moving on to quarterly expenditures. Ms. Kaiser. You don't know it from memory?
Nothing unusual. Expenditures, See if it'll, yeah. This computer, we need to get more memory on it.
Noted.
Nothing unusual. You should have it in your packet to be able to take a look at the quarterly expenditures. You will see expenditure. Yes, it looks like that. You will see the expenditures for the year for postage and supplies, for the pension administrator, and for liability. Those are the, on Patrick's report, it said 1% of payroll is to admin expenses. That's those expenses plus the attorney expenses plus the actuary expenses. That's what man and any conferences for that you might go to.
That reminds me, when is the conference coming up?
There's one in fall. In June. I haven't seen any information yet.
They have the dates, but no registration.
That brings up another question. We've always gone through you for going to those. We'll be going through you guys not going forward. Is that correct?
It's a timing issue.
Yes.
You probably want to get your hotel before.
Right.
People are officially on board.
Right.
Okay.
Just trying to get the details here. So that's how it would work going forward.
Yes, the computer.
There you go. Yeah.
Okay.
A motion to accept the expenditure.
I'll make a motion that we accept the financial report as given.
Is there a second?
Second.
There's a motion and a second. Any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Motion passes. Any public comments? Seeing none, we'll entertain a motion to adjourn.
One other business, meeting dates on June 4th is our next meeting, and because this room is occupied at 4:30, I believe, we had to move our meeting up to 2 o'clock. Instead of starting at 3:30, it'll start at 2 o'clock, but I'll put notices on your calendars.
Thank you for that.
Motion to adjourn.
We stand adjourned.
Thanks, everybody.